Hello everyone, a very good morning to you all. Welcome to the second lecture of Advanced Financial Management paper of ACCA. I hope you all are doing well. If you have any doubts from the previous lecture, please feel free to share it with me in the chat box. We'll try to address it right away. If not, we'll start our discussion for today's class. Okay, so what I have planned is that we'll do a quick revision of what we covered yesterday from chapter 1, and then we'll start off the new topics. Okay. So what did we understand? What is the primary objective of a profit-making company? It is wealth maximization and not profit maximization. Investors, what do they care about? They care about the future, that means the long-term prospects of the company, dividend, financing plans, how the capital structure of the company is going to be like, and the risk management. Okay. So that is the concern areas for investors. How do we measure the wealth of shareholders? I showed it to you with the help of ITC Wipro's example, right? So it is about the capital gain or loss and the dividend yield. If the company pays dividend, then that is also a part of the overall increase in the wealth of the shareholders. Can someone tell me how does paying dividend, why is that included as a part of the total shareholder return? Capital appreciation, we understand that yes, the share price has increased from, let us say, 50 to 100. So there has been a gain of 50 rupees, but dividend is received in the bank account, right? Why will it be a part of the shareholder's return? Or why it should not be, tell me? Yes, Ekta, because dividends, they are also a part of income. See, what will happen when you're holding shares? You will get money in the form of dividend in your bank account. That is one. Capital gain is like when you will sell the shares, you will be able to realize some value. In the current context, we can say that whatever is the current market price, that is my gain. So both of them. So dividend is part of the received income, and capital gain or loss is part of the perceived income, which will come in the future, because when we'll be selling the shares, that will be the gain or loss, whatever the situation is, right? Then we spoke about investment decision. Investment decisions are about creating, investing in projects which create wealth for the shareholders. Here, the most important metric is going to be the NPV of a project. All right. Next is financing decision. Financing decision, it involves about, how much debt will be there in the capital structure of the company, what the mix would be and everything. Here we discussed the 4 practical issues. What were they? Life cycle. If the company is new, then it should avoid debt. Okay. Then operating gearing. Operating gearing is if a company has high fixed costs, it should avoid interest burden, because it, having a high fixed cost denotes that the company has got high operating gearing. So it should not let financial gearing to get high by increasing the debt. So it should avoid debt in such circumstances. Next is stability of revenue. Stability of revenue will be if the company is going through a difficult phase where its revenue streams are not certain, then it should avoid debt, because it may not be able to service the debt in such a situation. Then last is security. Security is if, the asset, collateral asset, which you will be giving as a backup for your loans. If you do not have such security to offer, you should not be taking loans. Otherwise, you will have to pay higher interest, or it may be even impossible to get debt without security. Okay. So these are the practical issues observed while raising debt. Next is financial planning and control, which is a part of financing decision. What did we study here? That if a company is cash rich, it has got 3 alternatives ahead of it. What are they? Plans to use the cash for any investment, then pay out cash as dividend to the shareholders, and third is buy back its own shares, right? It will buy back its own shares in the sense, as we discussed, TCS, TCS buys back at a predefined price, which is normally higher than the market price. It buys them back and cancels those shares. So this is when a company is cash rich. When a company has problems with the cash flow, that means it is having deficit in cash flows, what it can do is that it can sell off some assets. But if it is doing that, it has to ensure that those assets are not crucial for the operations of the company. If you are selling your crown jewels, remember the term crown jewels means those assets without which the company cannot operate. Crown jewels. If the company sells its crown jewels, it will not be able to operate, and it might even have to shut down in such a situation. All right. So that is the last topic we covered. Now, the next topic is again on financing decision. But do you have any doubts so far? Can I start off the new topic? Please let me know if you have any doubt, so we can discuss that. No doubt so far. Cool. So let's begin the new topic, and that is assets. They can be divided into 3 categories. So as I said in the previous point, if you are having problems with the cash flow, you can sell off assets. What are these 3 types of assets? Number 1 is those that are needed to carry out the core activities of the business. For a manufacturing concern, so let us say it is a printing press. Okay, what will be its core machinery? What will be the core machinery for a printing press? The printer, right? Or you can say the binder. So these are the core, plant and machinery for a printing press. Okay. Likewise, you can take any company, any type of industry, and you will find out the core machinery, without which the existence of the company is not possible, right? Next category of assets are those that are not essential for carrying out the main activities of the business and can be sold off at a fairly short notice. Here we will have short-term marketable investments. So for example, when this is the function of the treasury team of a company. If you're having surplus cash, then you might decide to invest it in the shares of another company, right? Like shares or bonds issued by the government. Likewise, so you have options available, like a normal investor, a retail investor. Companies can also invest in shares. So that way, these assets, can a company survive without making investments? Can a company survive without these investments? Can it sell it off and realize money for use in its core activities? Yes. So these are the assets which should be selected for selling if the need comes. So it will be short-term marketable investments. Very important is the term short-term. Now I'll tell you why. So we have discussed that yes, we can sell off the investments. But can we sell off long-term strategic investments? Give me examples of long-term strategic investments which a company can make. Think and tell. Very good, exactly what I was looking for, Sai. Investment in a subsidiary. So when you're putting your money, that big of a money that you're acquiring a new company altogether, that investment in a subsidiary, that is a big, a long-term strategic investment of a company. Do you think these investments can be sold off at the same pace at which you can sell off these short-term marketable investments? the liquidity of short-term marketable investments versus long-term investment, tell me, is it going to be the same? It's not going to be the same. Ma'am, why is it relevant? See, normally you would want to, if you are having deficit in cash, you would want to sell off the short-term marketable investments. And still, if that deficit doesn't get fulfilled, then you might look at the long-term investments. Definitely, it will be a big decision because you invested in those companies with a long-term view. But if the need has come to sell off that investment, it will definitely not be an easy task. These are marketable, that means these are tradable securities. Whereas this is not something tradable. And you must know the rule of the law. I mean, this is what happens at the ground level, is that when you try to sell off your big investments at a short notice, that means a distressed sell. Remember these terms. When you make distressed sells of your primary assets, do you realize their true potential value? Imagine you have to sell your house at a short notice. Will you get the same value if you would have sold it with taking your time, meeting a lot of buyers? Definitely there will be a difference. I hope you're able to relate. Imagine selling your home in like next 15 days because you need the money. It will be hell of a task and you will not realize the true value of your home, right? Whereas if you reach out to potential buyers who will bid for your home, so that way you will be able to realize a better value. Same happens with the long-term investments made by a company. They may not be able to realize the full value if they start doing a distress sale of these assets. So are you able to understand? There are three categories of assets. I know you would have learned about fixed assets, current assets, but from finance perspective, you need to remember this. First is the assets which are important for the core activities of the business, like what? Plant and machinery. Second is the short-term marketable investments. You have put your money with the intent that, yeah, we will, sell it if the need comes. Then third is the long-term investments, the investments with which you made with a long-term view and a strategic point of view in mind. These are the three types of assets under which a company can classify. Is it fine? Very simple to understand. I believe you would have understood. Any doubts? Sure. No doubts. Okay. I would request everyone to please be active on the chat box. So what have we covered so far? We have covered, see, this graph, if you look at, we have covered investment decision, financing decision, dividend decision is yet to be discussed. Financing decision is what we just covered, right? The fourth one was risk management. Now let's see what is there in risk management. Post that, we will come to dividend decision, because these two decisions, they will get covered in the later chapters, but not dividend decision. Dividend decision is solely based on this chapter. Okay, so let's cover risk management. Risk management decision. Even this will come up later. Risk management decisions in the AFM exam mainly involve management of exchange rate and interest rate risk and project management issues. Okay, so you will have proper chapters on this, as I told you. There you are going, just 1 second. Yeah. So you will have to decide what are the how much of the risk can a company take in terms of its exchange exposure, exchange rate exposures, or the interest rate exposures. So that is covered in the very later part of our syllabus. Okay. And then the volatility of an organization's cash flows are a powerful influence on its approach to risk management. More volatile the cash flows are, the more important risk management becomes. Can you tell me why? Why is it relevant to have a robust risk management policy if your cash flows are volatile? Exactly. See, what do we do with risk management? We are trying to reduce the uncertainty in our business. If there is more volatility, it denotes more uncertainty, and therefore risk management becomes all the more important. Okay, so that is the reason it is given that more volatile. That means fluctuating. Volatile means what? Fluctuating. More volatile the cash flows are, the more important risk management becomes. Okay. And then we finally come to dividend decision. So all these three parts, we will revisit them in the later chapters. But dividend decision is very important. So please pay attention now. The dividend decision is related to how much a firm has decided to spend on investments and also how much of the finance needed for investment is being raised externally. This illustrates the interrelationship between these key decisions. See, I'll tell you with Excel, 1 minute. Okay. So what are the three types of decisions we have discussed so far? One is investment or investing decisions. Then next is financing decisions. And next is your dividend decisions. Please understand that this is a residual of what you are deciding here. Okay. So what happens is, when you make profits, let us say you have made a cash profit of 10 lakh rupees. Okay, this is the profit that you have made. Now, what will you think now that I have made a cash profit of 10 lakh rupees? I might decide that I want to invest 3 lakh rupees in my new company. Okay, in a new company or existing company to grow it. So 3 lakh rupees in new oblique existing company. Okay, this is what you might decide. Then 3 lakhs is what you have invested here. So you don't have any need to raise further finance, correct? So you don't need to think about financing. Next is your dividend decisions. In this particular example, where I'm having a cash surplus, this is what I'm thinking, that I will invest 3 lakhs in my new or existing company, and balance I will pay off as dividends. Okay. So why will a company not invest and rather pay dividend? I covered it in the class yesterday. Can you think and tell? Why will a company not invest and rather put the money in shareholders' bank's account? Think. What could be the reason why a company would not retain the money for investment in its existing company or its existing operations, but rather pay them to the shareholders? So Sai is saying because shareholders expect returns on investment. Not a right answer. Others also please try. Others, please try. Think an answer. Why would a company not invest on its own, but rather give money to shareholders to deal with the money as they like? I discussed this point yesterday. What do you think, Aishwarya, Ekta, Akash? Sai has answered. No response. What happened? See, a company will invest only as much as it feels that you're reaching their size. So let me complete my point. So a company invests only in those projects where the return exceeds the cost of capital. Now I'm telling a very important concept. Remember this, huh? Cost of capital is what? Cost of capital is the return which I have to give to my finance providers. Now, who are my finance providers? Let us say this is just an equity finance company. Okay, for the sake of simplicity, please understand that it is only an equity finance company. So what will be my cost of capital? Think and answer. Return from investment should exceed the cost of capital. Now tell me, what will be the cost of capital for me? Very good. The return expected by the shareholders. So in this case, cost of capital would be equal to the return expected by shareholders. Correct? Now, let us say this company only has investments, be it in the new company or in the existing company. Like even existing company have a limit now that only this much of incremental investment will bring me additional or incremental returns. If I keep on putting additional money, it might not yield me that much benefit. So the company knows that if I am investing 3 lakh rupees, only then this condition gets satisfied. If I invest 4,50,000 rupees in this, then it might not be true. So it is saying that, yeah, I will invest just 3 lakh rupees in the new company, new or the existing company, and balance, since I don't have, since the company does not have opportunities which give returns higher than the expectations of the shareholder, it will pay the excess cash profits to them so that they can they can invest wherever they feel feasible. I hope it is clear now. Now, Sai, why your answer was not correct? You said that you need to pay dividend because shareholders expect return. That is not the right statement. Why? Because it is not like shareholders get return only in the form of dividend. If you are not paying them dividend, what will you do? So in this case, let us say I do not pay any dividend to them. Whatever I make, I am going to retain in my business. See, whenever a company makes money now, so it has got two options available in front of it. It has two options. Very, very important. Please remember this. Huh? It has two options available in front of it. To retain the profits or to pay the shareholders. These are the two options which a company has whenever it gets or whenever it generates the cash profit. Now, in this situation, if the company is deciding that it will invest 10 lakhs in the business, then it will not pay any dividend. What does it mean? When it invests money in the existing business, or it is thinking of investing in any other business, in that case, its share price will increase. Why? Because its returns are going to increase. It will invest in the new or the existing company only if this condition gets satisfied. If this condition is getting satisfied, it means what? It is generating incremental profits. Whatever the cost of funds are, that 10 lakh rupees, if it is not what it is able to generate higher returns than what the shareholders can generate on by themselves, what it will do, it will invest in higher yielding securities or investments or its existing operations, and in that case its value will increase. The value of the company will increase in the form of the share price increase. So definitely, even if the company retains the profits, it will invest in operations which yield higher profits or higher return, I would say, higher return as compared to its cost of capital. This will lead to capital appreciation, that is, increase in share price. So shareholder is benefited through capital gain. Here, the shareholder is benefited if a company pays any type of a dividend. Shareholder is benefited through what? Tell me, how is a shareholder benefited if the company is paying dividend? There are two constituents of a shareholder's return. One of them is capital gain, other one is dividend yield. So shareholder is benefited through dividend yield. Okay. Yes, very good, Akash. Muna has a doubt. The decision to retain profits will be taken in AGM or it will be pre-decided and just be informed in AGM? This is more of a company law question, Munna, not relevant here for the finance paper. But anyway, it will be decided and it will have to be put forward, ratified in the AGM. Just to answer your question, the decision will be taken by the board and it will be put forward in the AGM and it needs to be ratified by the shareholders that yes, we are retaining this much money and we will be paying the balance to you as dividend. That is how the dividend decision, which is a mandatory decision in an AGM, that is taken. Okay. So coming back, is it clear? Are you able to understand this? So their company makes three types of decision: investing decision, financing decision, and dividend decision. And these decisions, they are interrelated. So let's say if I'm investing 3 lakhs, I will pay back 7 lakh rupees, because if I invest anything further here, I might not get returns from such investment which are higher than the cost of capital. Okay. So this is how you have to understand. Any doubts, please let me know in this discussion. Very, very important. This is very crucial. Are we good? Please let me know. You want me to repeat any point? Sai says no doubts. Why is Ekta and Aishwarya so silent today? Manan. Akash says yes. Munna, are you clear? Munna is also clear. Okay. Great. Then let's move ahead and come back to the slide. This is the relevance of this point. So Manan, we are discussing about the dividend decision now. We have just started off about this decision. And I was talking that whenever a company has got surplus cash, when it has generated cash profits, it has two options available in front of it. One is to retain the funds and invest it either in its existing business or some new business. Second option is to pay that money as dividend to the shareholders. So I was discussing why would a company want to retain the funds? A company would want to retain only as much funds where it generates return which is higher than its cost of capital. And what do I understand by cost of capital? Cost of capital is the return expected by the investors. Okay. So if I am able to generate returns, I meaning company, okay, if I am able to generate returns which are higher than what the shareholders can generate on their own, I will want to retain that fund and do my job as I will generate high returns for my shareholders. If I feel I don't have enough opportunities available to me for investment, I will give that money to the shareholders so that they can do whatever they want to do with that money. They want to invest, they can do that. So dividend is like deciding that I don't have enough opportunities ahead of me. I'll give the money to you, you invest wherever you want to. So Manan, could you follow this? Okay, great. This is overall the discussion which we have had so far. Now, why we had this decision is because, see, the first statement here is the dividend decision is related to how much a firm has decided to spend on investments. And also, this part I will come now. Also, to how much of the finance needed for investments is being raised externally. Now, think about this. So I have partially covered it. Let's take another example. This was example number 1. Let's take another example. Example number 2. Same decision I had to make, dividend, and this is the situation. Now imagine it has made a cash profit of 10 lakh rupees. It has an investment opportunity available in front of it, which requires 12 lakh 50,000 rupees. Will I pay dividend in this situation? I have an investment opportunity which is giving me higher returns than the cost of capital, but that is requiring 12 lakh 50,000. Will I pay dividends? I will not. Why will I pay dividends if I need that money? So I'll not pay dividend. Rather, here what will happen? I will be raising finance. I will be raising finance to the tune of 2,50,000. This may be in debt or equity, whatever the company might decide. That is a purview of financing decision. But in this situation, if I am needing 2,50,000 rupees, I will not pay dividend. So the idea to tell you all this is to say that dividend, investing, and financing decisions are interrelated. This illustrates the interrelationship between these key decisions. Okay, so if you're needing the money, if you're needing to raise finance under financing decision, obviously you will not be paying dividend. Unless until it's not like a ground rule, something that has to be done. A company might still pay dividend because it has a trend of paying dividend, and it might, and then in that case, it might have to raise external finance, also further extra finance. Normally, it is not done. In a sane situation, in a normal situation, it would not happen. But something extraordinary, everything is possible, right? So the dividend decision is having an interrelated relationship between financing decision and investment decision. Now let's see. That is what is getting captured here. Influence of the investment decision. If a company is growing, whatever we have discussed now, it's now getting covered in this slide. If a company is growing, then much of the cash it has will be better used to invest in positive NPV projects. So it will not have the liquidity to pay dividends. What did we discuss? That when it is growing, it will have more opportunities available in front of it, which is going to give me a return that is higher than the return expected by the shareholders. So it will not have liquidity. It will not have cash. Okay, basically liquidity means cash. It will not have the liquidity to pay dividends. Shareholder expectations will often be for low or even zero dividends in these circumstances. So even the shareholders, they will not even ask for, dividends in such a situation, because they know if the company has such good opportunity, let it invest. No, why take the money and we have to decide that, where to put the money. So let them decide, let the company decide where they want to put the money, as long as they are giving us the expected return. So that is the influence of the investment decision, which we covered in a lot of detail. Then next point, influence of the financing decision. As I said, everything is possible. If a company can borrow to finance its investments, it can still pay dividends. So in our example, it will not be a very smart decision to make, but it is possible, as I said. So what it can do, that it has a trend of paying dividend in the past. So what it will do, if it wants to pay the dividend of, let us say, 3 lakh rupees, it might raise it as finance. Obviously, it's not allowed. Actually, it's not allowed in India that you borrow money. See, this option is to be crossed off. In this situation, you will not definitely take money from equity shares. Same people, you'll not take money from them and then pay them back as dividend. That will be very stupid. And debt, you are borrowing from lenders and you are paying dividend to the shareholders. It is, in India, it is not allowed. It doesn't make sense. But it is, some countries they may allow, but in India it is not allowed that you take on debt to pay dividend to the shareholders. It is not legally allowed. That is why I did not explain that situation to you. But in the European countries, it is a possibility, and that is why it has been covered here. Okay. So have a look at this again. So to answer your question, Manan, it doesn't happen practically. It definitely doesn't make sense that you raise money and then you pay dividend. So if you have financing opportunities available in front of you, which is needed for investment, you will avoid paying dividend. That is the dividend decision you are making on the basis of the financing decision. If a company can borrow to finance its investment, it can still pay dividends. These are legal. See, it is mentioned here, there are legal constraints over a company's ability to do this. It is only legal if a company has accumulated realized profits. If it has some realized profits which it wants to use for paying off dividends, then it may. But again, it will not want to do it, because if it is needing money to invest somewhere, why will it pay dividend in the first place? So that is why it is very categorically mentioned that there are legal constraints in this way. But it is possible if the company has accumulated realized profits. Accumulated realized profits is the same as cash profits. Yes, yes, Akash, you're right. If it has cash profits, it can pay dividend, and then later it can raise finance for the balance. I mean, whatever investment they want to make. That is how it can do. So if it has cash profits, it can pay that to the shareholders, and then later, when the need for financing the project comes, it can raise finance further. That is the influence of the financing decision. But yes, not a practical one. Is it okay with everyone? Please let me know. Akash, is your doubt clear? Okay, great. Another factor which influences the dividend decision is the life cycle of the company. Do you expect new age companies, like the startup companies, to be paying dividends? They are anyways having a dearth of finance. They'll not pay dividends. Their intention is to reward their shareholders through capital gain. You know that the share value increases so much. I'm just not remembering the number. I'll Google that. You know, just one second. I'll show it to you. Interesting thing. You know, right? Shilpa Shetty is an investor in Nykaa. Sorry, not Nykaa. My bad. Mama, I meant. Okay. So I'll tell you that number. I'm just finding it out. Yeah, so this is the information that I was looking for. Okay. So Shilpa Shetty, she invested 6.7 crores in the company. I'm talking about Mamaearth, okay? 6.7 crores in the company and has acquired over 16 lakh shares at 41.86 a piece. A piece means per share. Okay. Shetty first invested in Mamaearth in 2018 when the startup used to sell only baby care products. The IPO rate is not mentioned here. It was a very high rate of yeah, that is the overall value, right? Yeah, 41 point Mamaearth. I'll just search for that. Wait. Mamaearth. Mamaearth share price. So she had invested at 41.86 in the company, and IPO price. Let me search. It was in the news when it broke. See, 1,085, approximately 1,100 rupees. Okay, just imagine the gain she is going to make. 16 lakh shares at, come here, let's see, 41.86, and let's say 1,200 approximately. That is going to be the listing price of Mamaearth per share, multiplied with 16 lakhs. I'm doing it in crores, okay? 185 crores of capital gain, capital appreciation is going to happen for Shilpa Shetty when Mamaearth gets listed. Just imagine. This is the expected prospective price for the IPO, and she had invested at 41.86. And imagine the gain, this investment. So how much she had invested? See, she had invested 6 crores, sorry, 6 crores in this, and she is going to make a return of 185 crores. Just imagine the type of gains which startups they can give, but I'm sure this price is highly inflated. This 1,200 doesn't seem feasible. Time will tell, right? So let's just come back to what we were discussing. Yes, sorry, 3,000% return, the capital gain. Okay, 1 second. So when its IPO comes, we will see that it news came in December 22 somewhere. Let's see when it gets listed. Anyway, so dividend policy often changes during the course of a business's life cycle. Reason why I showed you that is because, you know, new age companies, it's given in the graph here also. new age companies, they tend to, yes, it is going on with SEBI, right? Sai, you are correct. There is an issue with the company being highly overvalued. So if a company is young, there is limited, like zero or very next to zero dividend which is paid by the company. So this happens because the company wants to grow, high growth investment needs. It also wants to retain the money for investment in its own business. It is in a growing phase. A growing plant needs more water, right? So that way, a company also which is growing, it will require a lot of investment. So it will not tend to pay dividend during these times. So there is high growth investment needs. It wants to minimize debt. Obviously, it will not want to pay dividend, and then when the need for finance comes, it has to go to the lenders to provide them debt. So it wants to minimize debt as cash flows are unstable, right? We discussed that earlier also, like what are the practical concerns when it comes to raising debt finance. So it was one of them, right? Young companies, they tend to avoid debt. Similarly, young companies, they tend to avoid paying dividends because they are always struggling with cash. They want to reward their shareholders through capital appreciation, like the way Mama Earth could do for Shilpa Shetty. Okay, so that is about young companies. Now, mature companies. As I showed you yesterday, ITC is a dividend paying stock. So mature, it is a mature company, right? It got established in which year? Let me see. ITC established in it was established in 1910. Just imagine, yeah. So it's more than 100 years old. Obviously, it now knows its cash flows perfectly well. Okay, so it is a mature company. These companies can afford to pay higher dividend because they have a lot of surplus cash. In fact, within ITC also now, it's tobacco business. Tobacco business meaning the cigarettes, which it sells. That is the cash cow of the company. It generates, this is the segment. ITC has got three main segments. Can someone tell me what are the three main segments of ITC? The three main verticals of ITC business? FMCG, yes, you're right, Sai. Why is everyone so silent today? What happened? Sleepy Sunday? Very, yeah, that's correct, Munna. So hospitality means the hotel business, ITC hotels. Then tobacco, that is the cigarette business, and FMCG products. So these are the three main segments of the ITC business. And within this now, the tobacco business is the cash cow. It generates a lot of cash profits. So that is how it is able to pay such higher dividends to its shareholders. So it is a mature company which has got lower growth and investment needs because it is sustaining its existing business. It is not having such high growth opportunities in front of it. Debt is more suitable for such a company because it will get debt at very cheap rates. If a startup company goes in the market to raise debt, it will be charged very high rates of interest. Whereas if an established company goes in the market to raise debt, it will be at a very lower rate. Then next is the dividend capacity. We have decided, now we have come to the point where we know what all factors they affect the dividend decision of the company. But now we need to know how much a company can pay as dividend. That means its dividend capacity. Very important. And there are a lot of practical questions on this topic. You will have to do the calculations. So dividend capacity, investing and financing issues will impact on an organization's capacity to pay dividends. Dividend capacity is the cash generated in any given year that is available. Please understand there is a difference between capacity and actual dividend. So you might have a dividend capacity to pay $100 million as dividend, but actual dividend that you may just pay will be $2 million. Just discussing random number. So it is the cash which is available to pay to ordinary shareholders. It's not the actual dividend paid to the shareholders. Please understand the difference, okay? Dividend capacity is the cash generated in any given year that is available to pay to ordinary shareholders. It is also called as free cash flow to equity. Very, very important concept, okay? So what have we studied so far in dividend decision? It is influenced by investing and financing decision, okay? It is more relevant for mature companies because new companies, they want money to fund their growing business, okay? And this is what gives us the dividend capacity. Very, very logical. Don't worry, I'll just explain each one of these elements to you. Dividend capacity is what? The maximum amount that a company can, okay? The maximum amount a company can pay as dividend to its shareholders, which is also known as free cash flow to equity, okay? Now, let's have a look at this in the form of a Excel table, okay? So let us start off your dividend capacity. Okay, so what I do now, whatever discussion we have on Excel during the class, I put it as a tab as scribble in that relevant classes notes. So you'll be getting this classes notes now. So you will see a tab as scribble. Whatever discussion we have in Excel during the class, I just put it there. It's just scribbling what we are doing, right? So I retain it for your future consumption if you want. So dividend capacity, let's start off with the P&L format. First we have revenue, right? Then what do we have? Operating expenses, excluding depreciation. See, depreciation is also an operating expense only because it is important for, important to amortize the cost of the machinery which is being used for the operations of the company. So revenue is there, let us say 100 rupees. This is 40. Then we have depreciation also. Depreciation is, let us say, 25. Okay. So what do we get? If I hundred minus this. Now tell me one thing. What do I call it? What is this 35? What is 35 known as? Very good, Akash. It is known as PBIT, right? Profit before interest and tax. Okay. Then from this, I will reduce interest. Interest, let us say, is 5 rupees. Okay. What do I get next? PBT. Yes, Ashwarya, right. This is PBT. Oops, sorry. Yeah. So PBT. From this PBT, what will I do? Reduce tax. Let us say tax is at the rate of 30%. 9 rupees. Or do I get 30 minus 9, 21? What do I call it? PAT. Very good. PAT. Then what? Is this equal to my cash profit? Very good, Sai. I will add back depreciation. Add back depreciation. So I'll just link it here. Okay. Then I'll come to one concept later. I'm just noting down now. Noting this down here. I'll come back to this. So I'm adding back depreciation. Does everyone agree I need to add back depreciation? Everyone, please tell me if you're fine with adding back depreciation. Okay, so we added back because there is no cash outflow in depreciation. So it's a non-cash expense. Okay. Then what is my agenda? My agenda is to find out the cash flow for equity. Correct? Very good. Now think about it. I have to find out the cash flow for equity. If there is any preference dividend, I will be reducing it, right? So let us say there is a preference dividend of 7 rupees. Okay, that I will reduce. Then a very important thing which you need to know is that, yes, if there is any type of a capital expenditure or a debt repayment, I'll write it down. Debt repayment, if you have to make. See, interest we have already reduced. Basically, this is talking about the principal component also. The principal component of the loan which you are going to pay during the year. Let me write that to make it clear. Principal repayment of debt. That also I'm going to reduce because I am finding out free cash flow. This will require, all of these things will also require cash flow, right? So principal repayment of debt, let us say that is 2 rupees. Then next, there is some capital expenditure that you have to do during the year. Let us say that is 3 rupees. Okay. Very good. Incremental working capital investment, very good. Incremental working capital, that also I will reduce. Let us say that is 1.5. Okay. 1 second, I'll reduce. Okay. So 1.5 is the incremental working capital I need to make. Then I have also announced a share buyback. The topic which we just covered, right? A few slides back. A company can also buy back its shares and cancel it. Let us say it has announced it for 2.5. Okay. All of these things, they are impacting the cash flows directly. And that is why they will be reduced. Okay. One more thing which will increase the cash flow is going to be, can you give me an example? If I have reduced all of these things, principal repayment of debt, incremental working capital, capital expenditure, anything which could be added back, sale proceeds from assets, right? That is possible. So let us say that is for 6 rupees. Then share capital raised. Can I write that? Some 2 rupees, let's say I have raised as share capital. Then debt finance raised. Let us say that is for 1 rupee. So please tell me, do you agree with this? I'm finding out the cash flow. So to find out this, I'll be doing PAT plus this minus this, and this is my free cash flow for equity. 1 second. Yeah. So please tell me, till here all of you seem fine. Now confirm this also. I am finding out the cash flow for equity. With this, you tell me, are you able to understand this part or not? Take a moment, no hurries. Take a moment and let me. Everyone, please take your time and do confirm whenever you're done. Sai says yes. Yes, Munna, you are right. What we are doing is we are first finding out the cash profit, and from that we are reducing all those cash outflows which are not a part of profit element. See, all these things, these are not part of the P&L, right? So that is why we have reduced them separately. Again, we are adding those items. See, this is a non-cash expense, that is why we are adding back. But these are all items which are not pertaining to the profit, and hence we are adding them separately. We have to find out the cash flow. So for that, we are adding all these cash flows here. Got it? Okay. Manan, are you done? Yes, Sai, please let me know what is your doubt. Fresh investment. You're talking about this? Fresh issue. Yes, it is usually done for investment purpose. Yes. You're right. How can we include it in the free cash flow for equity? What are we finding outside? We are finding out the cash flows which is not subject to any other, I mean, which is not available for anyone else, only for the equity shareholders. And these are all the options which are available to a company during the year. I raised some capital, okay, 2 crores and 1 crore of debt. And I've invested about, if this is a dot, I'll change the number. I was randomly putting numbers. So capex, oh, it's just adding up only. Capex I have done is 3, right? I raised some finance, okay, and I've invested that 3 crores. Why will I not add it? Let us say, even if I would have raised 2.5 CR here, okay, and I would have invested 3 crores. Does anyone else have a right? Let's just ignore all of these things. I'm deleting these things. Let us say it's only this much. I have raised 3.5 CR. I've invested 3 CR in the capital. So whatever balance is left, it's for the shareholders only. Now, does anyone else have a right on that 0.5 CR? No. Everything in the company is for the shareholders only, right? So that is why it is a part of the cash flow available for equity. Yes, it shows the cash inflow and outflow even in the form of capex. Cash profit, profit from operating activities that we have found out using this. Balance all the adjustments. Okay, I'll try to simplify it more for you. 1 second. So I'm sure all of you would have prepared a cash flow statement somewhere in your life. Cash flow statement as per AS3 or IFRS 3, right? What are the 3 types of cash flows? Cash flow from, tell me everyone in the chat box. Cash flow activities, then cash flow from investing activities, and cash flow from financing activities. These are the 3 types of cash flows as per IFRS 3, correct? Now compare this with this. Don't you think what I'm getting here, when I'm just adding back this much, okay, 21 plus 25, this is nothing but cash flow from operating activities. I'll just copy this. Cash flow from operating activities would be this plus this, correct? Then cash flow from investing activities is how much? 6 minus capex minus this. Cash flow from financing activities would be how much? This plus this minus reference dividend minus debt repayment and okay, I'll also have to adjust for interest since we have paid interest, and this. And operating activities, I will also add back interest here. Now, have a look at this. 39.5, 39.5. It's a simple cash flow statement that we are making here. Please let me know if this helps you to understand the concept better. Have a look at this. Cash flow from operating activities will be what? PAT plus depreciation plus interest. Interest is a financing component, right? So cash flow from operating activities will be 51. Investing activities will be sale proceeds from assets minus capex minus incremental working capital. And finally, we have financing activities. All the other elements are of finance, right? So that is how I've covered them here. Let me know if you have any doubts. Munna says yes. Sai says all clear. Cash flow makes it much easier to understand. Yes, we are simply making a cash flow statement that what is the cash available for the company for distribution to its equity shareholders. This 39.5, does anyone else have a right on this cash? No one else. It's all belonging to the shareholders. That is why it is said that it is the free cash flow for equity. Okay, so I've linked everything. If you want to see later, you can. I'll just keep the links like that. Okay, then let's come back here and have a look at the table which is given. It's starting from PBIT, just to keep it simple. PBIT less interest, we have PBT. We reduce the tax, we get PAT. From that, we reduce preference dividend, debt repayment, share buyback, capital expenditure, add back depreciation, add back any capital raised from shares or debt. This is the free cash flow to equity. That means this is the maximum amount for which you can pay dividend. Is that okay? Right? This is the slide which is covered. Now, one important concept that I want to discuss with you, which is relevant not just for this particular section, this particular chapter, but for throughout finance, and say not even the AFM paper, throughout finance, it is going to be relevant. Some of you might even know it. The tax allowable depreciation. You know, right? Depreciation is, there are two qualities of depreciation. I'll just start a new topic now. Depreciation. And I want every one of you to have absolute clarity on this topic, okay? Depreciation is a non-cash expense, do you agree? And it is a tax allowable expense. These are the two qualities of the expenditure, right? Depreciation expenditure. Now, it is a non-cash expense, meaning what? We have to add it back. I mean, if I have to find out, so in simple terms, if I have to find out the cash profits, okay, I will simply reduce from revenue the cash expense. I could have done that 100, 40, and I could have got cash profits. But depreciation is a non-cash expense. Still, we reduce it, right? We reduce it first and then we are adding it back, like you all told me to do here, right? That, ma'am, you have reduced depreciation. You add it back later. This 25, I reduced it here and then I added it back later. Why did I do that? I could have simply not reduced depreciation here, right? I could have done that. Why did I not do it? I could not have just reduced depreciation, right? It's a non-cash expense. Why am I even treating it here? Tell me. Sai has given me the answer. Others, please let me know. If depreciation is a non-cash expense and I am trying to find out the cash profits of the company, why am I reducing depreciation? I could have simply avoided it, right? I could have simply not written depreciation here. Matter could have been easily solved. Why did I first reduce it and then add it back? Think and answer. Why did I write it in the first place? If it is a non-cash expenditure, think and tell me about it. Everyone is silent. Very good. Only Aishwarya and Sai have answered. What happened, others? You don't know the reason? It's okay if you don't know. I'll explain it to you. See, the reason why we do it. See, because of depreciation, our tax amount gets reduced. Have a look at it. So depreciation, when there is depreciation, what is the tax I'm paying? When I'm reducing depreciation here in the calculation above, and I'm paying tax at the rate of 30%. Okay. So I am paying tax with depreciation. How much depreciation? How much tax do I pay? I pay 9 rupees. Okay. Now let us say I do not reduce depreciation just because it is a non-cash expenditure. I delete it. Look at this. How much tax I am paying? As per the calculation, how much tax I would be paying? 16.5. Is it right? If I am having depreciation in my accounts, will I be paying tax at the, 16.5 of tax or 9 rupees of tax? I will still pay 9 rupees of tax only. But the calculation will show me I have to pay 16.5 rupees of tax. That is the reason, okay? Because depreciation is a tax allowable expense. It is reduced first to arrive at taxable profits. Okay, so 25, when I do again it, because depreciation is a tax allowable expense, it is reduced first to arrive at taxable profits. I just shifted downwards a little. After calculation of tax, it is added back to get tax, to get cash profits. Do you understand the reason why what we have done and why we have done that? Please let me know. Take a moment and confirm if this discussion is fine with you all. Let me know when you're done with this, so I'll tell you one more concept related to this. Is everyone fine? Ashwarya and Munna here. Fine, right? Okay. Now this balance, right? Okay, if anyone has a doubt, let me know. Okay, I'm just moving ahead. This difference meaning 16.5 minus 9, that is 7.5. This is known as the tax benefit of depreciation, which can, so this is what tax benefit of depreciation. It can also be calculated as depreciation amount multiplied with the tax rate, 0.3. Have a look. This, if there was no depreciation, I would have to pay tax of 16.5, right? Which is not right. If I am having depreciation, I have to pay tax of 9 rupees only. This savings in tax, which is coming because of that depreciation, is known as tax benefit of depreciation. Please let me know if this is fine. The difference in tax which is coming because of depreciation is known as tax benefit of depreciation. It can also be calculated very easily like depreciation amount multiplied with the tax rate. This is the, let me write it also, this is the tax which gets saved because of depreciation. Please let me know if it is fine. Is this part also fine? It's just an elaboration of what we have discussed. Right? Okay. So this is the tax benefit of depreciation. These are concepts which are going to come handy throughout the syllabus, and that is why I'm giving so much time right now. If you have any doubt, clarify it right away, because it's going to be very basic when the bigger calculations come. Okay, so I don't want you to struggle at that time, and that is why I'm just explaining all of these things right away. You should be all set for the big calculations. Okay, so this is the tax which gets saved because of depreciation. Now there is a similar concept of tax benefit of, can you tell me what? Anyone who is aware? What is the next concept I might teach? This tax benefit of depreciation we have covered. Another topic would be tax benefit of interest. Okay. Very, very important. Okay. So I will, okay. Let's start it below. Tax benefit of interest. What does it mean? See, I'll just copy this part. Okay. Let us say interest at the rate of 10%. Yeah, it's a new example. Huh? Treat it as a new example. I've just copied the numbers for saving time. The capital structure of a company is like this: debt and equity. Let us say this is debt is of 50. This is of 150 total. Okay, this is the total capital structure of the company. Now, interest is at the rate of 10%. So 50 into 0.1, 10%. Okay. Now tell me, because there is, I'll note it down in the same format as I discussed this. Okay. Tax with interest is how much? 9 rupees, right? Tax without interest, if there was no interest, how much would have been the tax? 10.5. Okay. It means that if there was no debt in the capital structure, tax of rupees 10.5 would have to be paid. Do you agree with this statement? Tax with interest is 9, tax without interest is 10.5. It means that if there was no debt in the capital structure, tax of rupees 10.5 would have to be paid. Just forget this, okay? Just don't read this much. Is this fine so far? Do you agree or not? Okay. Now I'll just put this back, okay? Because interest is a tax allowable expense, it reduces the cost of debt. Okay. Because interest is a tax allowable expense, it reduces the cost of debt. What does it mean? That when I am paying interest of 5 rupees, okay, the net interest that I am actually paying is savings in tax due to interest is how much? Net interest, can I say, is this much only, 3.5. When I pay interest of 5, can I say the net impact on my PNL is of 3.5 only? Please read these statements and let me know if it is okay with you. Okay, guys, for everyone, if you feel you are getting lost behind, don't worry, just let me know if you want me to repeat any concept, be it depreciation also. These are very critical concepts and they're going to be super useful in the coming days. So if you want me to repeat anything, I'm already going very slow now. If you want me to go slower, just let me know. Okay, don't feel shy. So savings in tax due to interest is 1.5. It means that when I am paying interest of 5 rupees, the net impact on my PNL is of 3.5 only, 5 minus 1.5. This can also be calculated as interest multiplied with tax rate. What is it? 5 multiplied with 1 minus 0.3 as factor, tax rate factor it is called. Okay, this 3.5 can also be calculated as 1 minus 0.3 multiplied with interest. What I've just calculated here, na 3.5, how did I get that? Total interest minus the savings in tax due to interest, that turned out to be 3.5. This net interest can also be calculated as interest multiplied by the tax rate factor. See, remember this in finance language, what is the meaning of the term factor? Tax rate is 0.3, correct? Tax rate factor will always be 1 minus 0.3. Okay. Similarly, any rate, like let us say interest rate, if I call is 0.1, that means 10% is 0.1. If I have to, write, if I'm using this terminology, interest rate factor, you know what I'll be doing? Here it will be 1 multiplied, 0.1 1 plus 0.1. Factors, tax rate always a reverse factor because taxes are reducing expense. Interest rate factor, if I am calling anywhere, or inflation rate, similar. I'm giving more examples now. Inflation rate is, let us say, 8%, 0.08. Somewhere if I use inflation rate factor, what I would mean is it should be 1.08. Okay, so this, coming back, net interest, if I have to calculate directly, I can calculate as interest amount multiplied with the tax rate factor. Don't get confused, just look at the discussion, this discussion. Is this fine? I'll explain the concept of factor later whenever the concept comes. Since the word got mentioned, I have explained it to you like briefly. Is this part clear? Can I say when I'm paying an interest of 5 rupees, the net impact on my PNL is of 3.5? This 3.5 is calculated as interest minus the savings in tax specifically due to interest. Okay, this is calculated as interest multiplied by the tax rate factor. How do I calculate the tax rate factor? It is 1 minus the tax rate. Please look at this and confirm to me if you're fine. I'll wait for a moment for everyone to confirm. Aishwarya says yes. So we studied two topics, tax benefit of depreciation and tax benefit of interest. So first one was to address the doubt, ma'am, why do we reduce depreciation first and then add it back? Why did we do that? Because depreciation is a tax allowable expenditure. Okay, let's just revise it. Depreciation is a tax allowable tax allowable expenditure. So that is why we reduce it first and then add it back. If someone asks me directly, what is the tax benefit which happens because of depreciation, I can calculate it directly like tax amount, depreciation amount multiplied by the tax rate. That is the tax benefit of depreciation. Okay. Similar to that, savings and tax due to interest or tax benefit due to, like I'll use the same terminology so that you don't get confused. Right? Similarly, having debt in the capital structure also reduces my tax. So that is why I calculate tax. I calculate net interest. Okay, what is that net interest? It is gross interest minus the tax benefit due to interest. Okay, so interest, what I've paid is 5. Because of having debt in the capital structure, the net impact on my P&L is of 3.5 only, as there is tax savings because of interest. 3.5, very, very critical and important concept. Till the last date, we will be using it. So net interest will be of 3.5. Rather than calculating first tax with interest, then without interest, and arriving at this number, simply what we can do is interest amount multiplied with the tax rate factor, and that is 3.5. Okay. So with that, I've just done a quick revision also of these two topics, tax allowable depreciation and interest benefit due to tax benefit due to interest. Now let's come back to the slide. So remember this, PBIT minus interest minus tax plus add back depreciation, add back if you have raised anything from the share market or the debt market, and reduce preference dividend and debt repayment, share buyback, capital expenditure, if any. This is your, what you will get as a result will be the free cash flow, or the balance cash flow available for equity shareholders. Okay. Now there's a question for practice for all of you. You are going to do it on your own. Okay, 1 second. So in this question, you have to find out the cash flow available for equity shareholders. Okay. Calculate the cash flow for equity shareholders. The following projected financial data relates to CX company. Operating profit is 400. Depreciation 60. Finance charges paid, meaning what? What do you mean by finance charges paid? Yes, Manan, right. It talks about interest. Finance charges paid is same as interest paid. Don't get confused. Huh? Preference dividend paid is given. Tax paid is given. Ordinary dividends paid. Dividends paid is given. Ordinary dividend means what? What do you mean by ordinary dividends? Correct. Equity dividend. Ordinary shareholders also, if you see a term somewhere, it is the equity shareholders. The book value of CX's non-current assets last year were $200 million. This is projected to rise by $40 million. CX company is planning to repay $100 million of debt during the next year. So find out the dividend capacity of this company. Okay. Take 5-10 minutes. I'll be here. Share your answers in the chat box when you are done. This is the data for you. Okay. Solve it in Excel. Open Excel in your laptop now and solve it there and share your answers. Okay. Everyone, please do solve and don't sit idle. It's time for your practice. So practice in Excel and share your answers when you're done. So you have to estimate and comment on the dividend capacity of this company. This is the data. Solve it and share your answers. So I've got answers from Sai, Munna, and Ashwarya. Okay, only one answer is correct. You're getting mistaken at one point. Mona, not sure how you got 260, 240 answer I'm understanding. But 260, how did you get? Manan, Avinash, please do share your answers as well. We always practice, huh? Like when I'm giving these classwork questions to practice, it will help you to understand what's your progress, where you're making mistakes. Manan and Avinash, please share. If you're working, just let me know. I'll wait for some time. Avinash Singh is also saying for 240. Manan, what about you? Mona is saying 240. Okay. Everyone is saying 240 except for Sai, who says it's 140. And the correct answer is also 140. Okay. I know the point where you got confused. Let me know if I'm not right. CX company is planning to repay $100 million of debt during the next year. Okay. And tell me one thing about this. This debt, which it is going to repay next year, agreed. Dividends, when will it pay? So let's understand it with the help of the timeline, okay? It's the answer. I'll discuss that with you. But anyways, first the point where you're all are getting confused. How does it work? So let us say the year is 2021 and 2022 for that matter. Year 2022, profits for the year. Okay. Year is 2022 and profits for the year is whatever, 200. Okay. Dividend will be paid in which year? Tell me. Profits for the year 2022 is 200. Answer my question. Dividend for this year will be paid when? In 2022, will you go back in time and pay dividends, or will it be paid in the next year? When will it be paid? 2022 or 2023? Anyone who has a second thought, no, will go back in time and pay into in 2022. It's not possible only. Because you will be doing these calculations later, right? So anyways, also you will see that after the books of a company are closed, only then they decide what is the dividend to be paid. Like in the Indian terms, the books get closed on 31st March. The dividend, 31st March of, let us say 2022, books will get closed. And on 30th September 2022, the dividend decision is taken. And dividend is being now paid in the next financial year, which is what, 2022-23. So dividends are paid next year. So that is the reason, therefore, debt repayment next year will be deducted to arrive at cash flow available for equity. Please let me know if you have understood the error which you have made. Those of you who said 240 as the answer, the self note. Please let me know if this part is clear. Every one of you made this mistake, right? So with that, now let's come to the solution part of it. I'm getting yeses in the chat box. I'm understanding this part is clear. So whenever you are paying dividend, it is always paid in the next year. So that is why debt repayment, which will be done next year, that will also be deducted to arrive at the cash flow available for equity, right? Now with that, let's start. We were given with the operating profit of $400 million. Now, very important, as I told you, to give proper labeling, write this dollars in million. Okay. So operating profit is 400 million. Then next we have interest. Interest was given to us directly, finance charges paid. Okay, one more thing. Why did we not reduce depreciation from operating profit? I'll write that also down as a note. You also tell me, why did I not reduce depreciation? You also did not reduce, right? Why did you not reduce depreciation? Akash is giving me the wrong reason for not reducing. Akash. Others also please answer, and then I'll write my note here. Sai, my question is that operating profit was given to us 400, then depreciation 60 was given to us. Why did I not deduct depreciation 60 here, and then I would have calculated the profits? Why did I not reduce depreciation? No, that's also not the right reason. I told this when I was discussing this concept with you. Depreciation is also an operating expense. Okay, remember this. Some of you are giving me the right, Ashwarya and Avinash have given me the right answer. See, depreciation is also an operating expense. So, if operating profit is given, it means depreciation would already have been deducted. Hence, it is not reduced again. Please let me know if you have understood this. So if operating profit is given, it means that depreciation would already have been deducted to arrive at it. Hence, it is not reduced again. Is it clear? Those of you who are giving me other reasons, have you understood why have I not reduced depreciation from operating profit again? Because operating profit is revenue minus the operating expenses. Fine. So if operating profit, that is revenue minus operating expenses given, it means depreciation would already have been deducted at to arrive at it, and it is not reduced again. Okay. Then less interest we have done, so we get PBT. See, these are the small things now which you should be careful about. When you make mistakes, you have realized this, and I'm sure now you will not forget this ever. Avinash says, what would have been the case if in the question it is given that company will purchase non-current assets of $100 million in next year, whether it would also be deducted? I'll come to your question. So let's just continue in the front. I'll come back to your question. So PBT would be 317. Then tax paid is given as 75, right? Then profit after tax will be what? 370 minus 75. Then we have less preference dividend. Very simple so far. Then capital expenditure. See, I've done a note for it. Okay. See how I've done that. We know how to make a fixed asset account, fixed asset ledger. Do you all know basic? So we were given, have a look at the question, and Avinash, your question will get solved now. The book value of CX's non-current assets last year were 200 million. This is projected to rise by $40 million. What does it mean? I know you did not pay attention to it when you were reading the question, but what does it mean? It is talking about the next year only, right? So this is projected to rise by $40 million. It means that this increase will happen in the next year, right? Avinash, did you understand? You are already deducting the assets which will be acquired in the next year. It's not the assets which have been acquired in the current year, because that would have been relevant for the dividend capacity of the last year. Okay, so it is a rolling number. You use the profits of the current year and all the investments which you are going to make in the next year, be it in investments in the fixed assets or any type of debt repayment, all of that is pertaining to the next year. Okay, so the book value, now coming back to the calculation of what is the capital expenditure. So the book value of CX's non-current assets last year were $200 million. That means the opening value or the opening balance is going to be $200. Then closing balance is expected to be higher by 40. So we have done 40. Then depreciation, we are going to take as per the number which is given in the question. So depreciation is 60. And what do we have as the balancing figure then? That 100 will be the capital expenditure for the current year. Please let me know if you have understood this. I've made a capital expenditure account for you to understand, and this 100 I have linked. See here, 300 minus 200 and capital expenditure I've linked with this. Okay, is it fine? The capital expenditure will be of 100. Debt repayments 100 directly given. Then depreciation we are adding back 60. Okay, and sorry, yeah, 100. And what do we get? Dividend capacity is 140. The dividend which they have paid is of $60 million. It means dividend could be increased. You're finding it post facto. That means after you have paid the dividend, you're finding out the capacity just to check whether the dividend which you paid is within the capacity or not. So you find out that the dividend capacity was for 140, but the actual dividend that you have paid is for 60 only. So there was more scope for paying dividend. Okay, so that is the comment that we can make. Is everyone fine with this? Any doubts? Capital expenditure, be it in terms of debt repayment. See, these are small questions which will help you to solve the bigger ones. Okay. So what have we done? I just repeat the steps. Operating profit was given to us. Interest we reduced. We get profit before tax, 370. Then tax was also given to us directly, 75. I'll explain it, Manan. No worries. So from that, we reduced tax 75. We get profit after tax 295. Preference dividend was given to us directly. Capital expenditure, I'll come back again. Debt repayment, now we understand. So I'll give this note 1 and note 2. This will be note 2. This will be note. Actually, this is not something which you should give in exam. This is a logical understanding, and that is why I called it, self-note. So I'll not give a note for this in exam. Depreciation I will give. Depreciation. Okay. So this one is fine. Capital expenditure, I'll come back to this later. Debt repayment, I have given a self-note here. This is not something you should be writing in exam, but this particular note you can give. Like rather than preparing a capital expenditure account, you can write in a plus minus mode. That also you can do, but this account form is also acceptable in exam. And depreciation point also you can write. But again, this is avoidable. You can call this one also as a self-note. Rather, let's keep it as a self-note only. It's not for the examiner to understand. This is a basic understanding which a student should have. So I'll remove the reference of note from here also. These two are self notes. Okay, self notes meaning whenever I write self notes, it means it is for your own consumption, not to be written in exam. But if I'm writing note, it means this is a note which you should give in exam for the examiner to follow. Because yesterday, as I told you, the examiner should be able to follow from where you're getting the numbers. So you have to show him how you got the numbers. So for capital expenditure, this is coming from here. How did I get it? Now, Manan, please have a look. I'll just delete everything, okay? I'm deleting everything for the time being. Let's just prepare a capital expenditure or a fixed asset account. I'll write it down. Right, we make it in our accounts classes. So opening balance, Manan, was given as $200 million, right? And depreciation was given as what? 60. It is given that the balance of the fixed assets will increase. It is expected to increase by 40. Okay, so that is 240. Tell me, what do we have in the balancing figure? We have opening balance, we have depreciation. I'll just total this. Now tell me, this ledger is not tallying. What is the missing figure then? We would have purchased something. Now, when we purchase an asset, what is the entry we pass? Fixed asset to cash or bank, whatever you want to write. Balancing figure. So can I write it as 300 minus 200? That is 100 is the asset to be purchased. Manan, please let me know if you have understood it now. Got it? Okay. So this is the capital expenditure. We will link it here. Debt repayment logic I've already explained, that I've given as a self note also. Depreciation we will be adding back. Why are we adding back? Because it is a tax allowable expenditure but a non-cash expense. So it would have been reduced above to calculate the tax amount correctly. Now it will be added back to give the impact of cash. Now the dividend capacity, it turns out to be 140. I've done plus and minus here. Dividend capacity is 140 and ordinary dividend is $60 million. It means dividend could be increased. Now for you to note is how I am presenting my answer. If this question would have come, this is how you also would have presented. Only this much, okay? Not self notes are not needed for exam purpose. This is how you should have also presented. All right. So start observing these things. You know how I'm giving reference of note, and the statements. So it was supposed to, a calculation of the dividend capacity and also comment on it. So I've written a small comment that, actual dividend paid is $60 million. It means dividend could be increased by further $80 million. Okay, because the capacity is 140 as against the actual of 60 which has been paid. All right. So on that note, let's come back to our slides. Required, this is done. Then let's pause here for the timing. It's 12:11. Let's catch up at about 12:30. Okay, 12:30 we'll catch up, have a small break, eat something, and then come back. See you after the break. Yeah. So let's continue our discussion. We discussed about the dividend capacity concept. You have also solved a question on this. Now let's move to the next part, which talks about the different types of dividend policies. Okay. So having considered these factors, companies will formulate and communicate their policy to ensure, there are different types of dividend policies which are followed by each one of the companies, and these policies are communicated to the shareholders so that they have realistic expectations regarding the dividends they are likely to receive. Okay, so this will be communicated to the shareholders so that there is no unforeseen expectation from the shareholders, and which might affect the share price of the share in the stock market. So what are these policies, different types of policies which are followed by companies to decide the amount of dividend? Number one is constant dividend payout ratio. Okay, so what does it mean? Let's come to Excel. Next topic is dividend policies, out of which number one is constant payout ratio. Okay, it means that, let us say, I just copy this above number, all right? This is normally done on the profits. So interest is 5. Okay, add back depreciation, and depreciation is 25. Okay, let us say these are the only items. So we have cash profits. Okay, 46. Constant payout means payout ratio is, let us say, the company has been following a payout ratio of 30%. Dividend amount would be how much? 46 multiplied with 30%. That is how the dividend will be paid each year. Okay, this is a constant payout ratio concept. Now, whichever, let us say this is for year 1, the same thing in year 2 is, let's say, 120, then equals to into 0.4, depreciation is same, interest is also same. This is the performance in year 2. What happens in year 3 is that the company suffers a major blow in its markets. Its sales fall dramatically. So it becomes, let us say, 60. Yeah. Now you will see this trend, if I were to draw a graph of this. One second. So you will see these numbers. These numbers, you are seeing that it was growing in a constant trend. For the first year it gave 13.8. Next year also it gave a substantially good dividend. Next year there is a dramatic fall because it is following a constant payout ratio 30%, that it has decided that 30% of my cash profits I will be paying as dividend every year. This is the policy which the company is following. With following that policy, it is just giving an 8.8 dividend. What will happen to the shareholders? Shareholders, will they be fine with this approach? Because when the big shareholders, they have major dependencies on the dividend amount, because they have an expectation that every year the company has been declaring dividend in the range of 13 to 15 crores. This year also it should be paying that much, and suddenly it is told that they are going to pay just 9 crores of dividend. There will be a major repercussion in the market. Do you agree or not? The share price will fall tremendously, because it will show that the company's results have deteriorated so much that they are not able to pay dividend. Okay, and I'll tell you one example also for this. Just one second. Yeah, let me show you one. It's very interesting example. Okay, come have a look at this. MRF share price I'm finding out. Okay. One share of MRF is of 85,000 rupees. Okay, just one share. In whatever has been the trend in price, it's fine. 1 year, if you look at this, it has grown from 60,000 approximately to 85,000. It's a very big share. I mean, it is very illiquid because of this, because the value of the share is very high. One piece of MRF comes for 85,000 fee. What? The dividend it paid. This time I'm talking about in 2020, it had this, you can see, rupees 3, rupees 54. This is still older. I am remembering in 2021, I believe, they had paid a dividend of 1.5 rupees per share. And the day they declared the dividend, now the share falls more than the amount of dividend they declare. Like, imagine on 85,000 rupees, you are paying a dividend of 1.5, 1 rupee, 3 rupees. It is like penny for that stock, right? So, there was a major setback in the share market because of this. So that's what I was saying, that, dividends, the shareholders, they have certain expectations from the company with respect to the dividends. If the dividends, they fluctuate so much, definitely the company will lose money in the share market. Okay, just one second. Yeah. So the amounts can, the fluctuation in dividends can actually impact the share price, which is not a good thing. So I'm just telling you that this is the policy. What is the limitation of this policy? Then the second policy which the companies follow is stable growth. Stable growth, as it's set at a constant payout ratio, is logical but can create volatile dividend movements in profits if the profits are very volatile. Next is stable growth policy. Let's see how does this work. Let me show it to you with numbers. Stable growth. How does this work? stable growth. So in this one, what will happen? Let's start off with profits here and cash profits. Okay. Then number of shares. Let us say the number of shares is 2000. That I just writing 2 here. Okay. So dividend per share, what they will do is they will follow a constant growth. So in this year, they paid a dividend per share of 14. Okay. Then dividend amount will be how much? 2 shares of 4, and dividend amount is 14 rupees, so 28 rupees of dividend amount. They are following a stable growth of 5%. So every year, the dividend, now see, I'm using a factor 1.05, right? I will increase it by 1.05, then again into 1.05. And this is seeming fine. Okay. Here, you will say that, ma'am, the company is not having sufficient cash profits for the year. How will it pay 30.9? Is it a valid question? Dividend amount and cash profits, right? You'll have this question in mind, like, how is it possible? So here, the company will be paying from accumulated profits. So let us say this was the first year of the company's operation. So it will have an accumulated profit of 18. Then 18 plus, what will be the accumulated balance? Minus 29.4. So it will have enough balance, right? 43 it had balance, 29.2 profit of the current year, minus 30.9, it will pay. Okay, so it can pay from the accumulated profit balance. Are you able to follow me? Please let me know if you have understood this part. This policy is actually, it gives stable income for the shareholder. So they know that, yeah, every year my dividend will increase by approximately 5%. Okay, Ekta says last part. See, last part, what I'm saying is, see, let us say this was the first year of the operation. First year of the operation of the company. Okay, year 1. So what will be the accumulated profit of this company? 46 minus 28, the dividend it has paid, this will be lying in the accumulated profits of the company, right? Next year, this will be the opening balance plus the profits of this year minus the dividend paid in the current year. So that translates to 43 rupees of balance in the accumulated profits. Then next year, 43 plus 29.2 minus 30.9. So it comes to 41.3. Okay. So the idea is to tell you that if in a year profits fall short, the accumulated profits can be used to pay the dividend. Okay. So I'll write this under this policy. If profits for a year fall short, then dividends can be paid from accumulated. Understood? This policy leads to volatile dividend payments. Understood both the policies? Let me know. Everyone. Okay, great. Then let's come back, have a look at this. So we have understood stable growth set at a level that signals the growth prospects of the company. Next is residual policy. Only pay a dividend after all positive NPV projects have been funded. So once you are done, like all the capital investments, everything that you have decided, suppose that whatever money is left, see, like we did in this question number 1. Here in a residual policy, what will happen? Whatever is left out after all the investments, all the expenditures, everything has been done, that will be paid out. Residual policy. This is the residue, right? So all of that will be paid. Okay. So this is how you have to understand the residual policy. Like whatever is the balancing amount, it will be paid. Okay. So let's come back. Only pay a dividend after all positive NPV. Positive NPV meaning what? The projects which give, returns are higher than the costs involved for that project. So all positive NPV projects have been identified, have been funded. Okay. So these are the 3 types of dividend policy. Now, what next topic is, what are the methods of distribution of earnings to shareholders? See, we have learned one method till now, and that is the cash dividend approach. Okay, that whatever amount you want to pay to the shareholders, you pay it in cash to them. But there are other methods of distribution of the earnings to shareholders as well. And those methods are, number 1, scrip dividends. So scrip dividend is like a bonus share. How many of you heard about bonus shares? Akash has heard. Anyone else? You know about, right? Most of you would have heard. So let's come here to Excel. So scrip dividend, that is bonus shares. Okay. So what happens normally when you are paying, when cash dividend is paid, it puts stress on the liquidity of the company. Okay. If a company still wants to reward its shareholders, it can pay bonus, or it can give bonus shares to the shareholder at no extra cost. Okay. So let's just understand what it means. Mr. A shareholder of XYZ company. Okay. Mr. A, he's a shareholder of XYZ company. He has number of shares is 10,000. Okay, he has 10,000 number of shares. Cost price is, let us say, 50 rupees. Value of investment is 10,000 multiplied with 50. 5 lakhs investment we have done. Now, company announces a dividend cash dividend of rupees 5 per share. Okay. So dividend which he will get is how much? 10,000 multiplied with 5. Okay, this is the value he will get in his bank account. This is possibility number 1. Possibility number 2 is company announces a scrip dividend of 2:1. It means that for every 1 share held, Mr. A will get how many shares? 2 shares. Okay. Now, number of shares will be how much? Into 2, can I say? This will be the bonus, number of bonus shares. Total number of shares will now be how much? Total number of shares will be this plus 20,000, 30,000. Has he put in any value to, money to get this? No. So the value of investment, it will remain the same at 5 lakh rupees. Correct? So price per share now will be how much? 5 lakh divided by 30,000. 16.67. Benefit per share is how much? See, have a look. 50 minus 17. He has got a benefit of 33 rupees per share. Okay. Obviously, these values are not like real values, but I'm telling you from like how to get the benefit under scrip benefit. So the benefit which he has got per share is of 33 rupees. Whereas in this one, he got a benefit of rupees 5 per share. Is it fine? Have you understood both the situation? Cash dividend impact and scrip dividend. So these are the 2 ways in which a company can pay dividends. Everyone fine now? Can I move to the next topic? Okay. I'll come back to it, Mona. 1 second. See, earlier, yeah, Manan, it can do both. It can do both. And it's scrip dividend, not script. Okay, it's called scrip. Yes. So Munna has a doubt that, ma'am, can you explain the benefit again? See, how is it calculated? Now, value which he had put was 5 lakh rupees. Now, how many number of shares does he have in total? Number of bonus shares is going to be 10,000 multiplied with 2. 20,000 bonus shares he will get. So how many number of shares he will have in total? 10,000 he purchased, right? And 20,000 he got for 3. So he will now have 30,000 shares. Correct? The value of investment remains 5 lakh. He has not put in extra money to get the bonus shares. Now you tell me what will be the price per share? It will be 5 lakh divided by 30,000. So 5 lakh is the amount he has put for basically 30,000 shares, right? So this will be the price per share. How much has he benefited in this process? 50 was the rate he was having earlier. Now the cost of his investment has come down to 17. So the benefit per share that he is getting is of 33. Got it? Mona? I'll tell you. It falls after dividend also, Avinash. That's why I did not, because that in fact, that what you're saying now, it will happen in both the cases. So even when, so what Avinash is saying, in reality, share price falls down after bonus issue. To that I'm saying that share price falls even after dividend, X dividend price, X bonus price. So in this case also, although he is getting a dividend of rupees 5 per share now, the price of the stock will fall from 50 to 45 on the same date when he gets the dividend. Okay. And here also the price will fall by 33 rupees. But how does a person gain over the period is because of value appreciation. I'll come back to your doubt, Muna. To address your doubt, Avinash, in reality, what will happen? The share price will fall by 5 rupees in case of dividend, and in case of bonus, it will fall by 33 rupees. Okay. But over the period, the share prices will change. Okay. Now this 17 rupees in the market will now ultimately become 24, 25, 35 over the year. But the number of shares has increased substantially. That is how that is how a shareholder gains money in the long term. Are you able to follow me, Avinash? There is X dividend price also and X bonus price also. Not clear? You want me to repeat? Yes, it happens in both the cases. That's why I did not touch upon this point. Because the impact will happen in both. Bonus also and dividend also. Yes, it takes years. So you know about BPCL. I'll show you one example. When was it? Which year? It was 2022, I think. BPCL dividend 2022. It paid a very, very large dividend. And since then, the price of BPCL is very, very low. I'm not getting it. Some in hundreds it had paid. It was a very big amount and it brought down the value of the share substantially. The dividend gets credited to the shareholders' account instantly, but the appreciation in the value of the share that comes over time. Okay, Avinash? Now coming to Munna's query, Munna says that, ma'am, ratio is 2:1. So Munna, please understand how to interpret this. I have written it also here. When the ratio is given like this, no, company announces a scrip dividend of 2:1. It means that for every one share held, I've written it here. For every one share held, Mr. A will get 2 shares, 2 bonus shares. So how are you getting 5,000 shares? I'm not understanding that. You're reading it opposite, I think. You are saying that for every 2 shares held, Mr. A will get 1 share. That's not the right interpretation. This is how you follow. Okay. So yeah, I hope you understood that a company can benefit. Okay. That is to avoid, Akash is saying, ma'am, can you please explain why share prices decrease after dividend or bonus issue? It is to avoid arbitrage. Now, have a look at this. So let me see if I can get a real data. X dividend and dividend. One second, I'm looking for some real data to share with you. Let me see if I can find it. not getting the data. Anyways, I'll explain it to you. So there are two concepts, ex-dividend, and same applies to bonus also. Ex-dividend and cum dividend prices. Okay. Share prices. What happens is company announces, okay, share price is trading at 300. Okay. Company announces a dividend of ₹5 on 1st March, on 5th March. Okay. Then what happens? The stock market reacts to it. The share prices tend to increase by that much amount. These are all ideal scenarios I'm talking about. When a company announces a dividend, the share prices increase on the date of announcement. Okay. And then there is a record date. Record date is the date shareholders who are investors who remain shareholders of a company on that date, they are eligible to get the dividend. Okay. So record date is, let us say, 7th March. Not so close. It is, they give some time. So let us say that is 15th March. Whoever is the shareholder of the company on 15th March, they will get the shares. Okay. Now see how things work. There are two types of sellers. I was not getting data for this. I'm just taking random numbers now. There are two people, Mr. W and Mr. X. Okay. These are two different types of people. Both of them hold the shares of this company. Mr. W, what he wants to do, he was in the share, like he was holding the shares only for the short term. Okay. Short term investor, and he is a long-term investor. Okay, Mr. X is a long-term investor. What happens is that when the dividend is announced, he sees that, wow, I'm getting an increased price today in the market, I will sell it today. So this person, he will sell the share on 5th March. Okay, Mr. W. Mr. X, what will happen? Okay, gain will be how much for this particular person? Both of them purchase the share on 1st of March only. Okay, so the gain for this person is also 5 rupees. He has made a gain. This person, he is holding for the long term. He doesn't sell it. So he gets a benefit of, or credit of, 5 as dividend. Get credit of 5 as dividend on what date? Whatever, after 15th March, let us say 20th March, the company is paying off the dividend. So credit of 5 rupees as dividend he will get. And again, the share price, okay. Then recorded is 15th March, share price on 15th March will again come down to 300. Okay. So on 15th March or on 20th March, let's say, for comparison purpose, on 20th March, both of them are in the same parity situation. He made a gain by selling the share. This person made a gain, same gain, by getting the dividend in his bank account. By this logic, none of them get any extra benefit. Now this person, because he is a long-term investor and he sees that the company will grow over the years, he will keep on holding the shares, and one day the price of the share will become from 300 to 600. That is his gain, which he will make over time. And by this time, Mr. W, he would have invested, reinvested, sold, invested, reinvested, sold. He would have gained by that logic. But this person, he would have held on to the shares of this company for that long duration and he would have gained over time. But for this particular 20 days, both of them, they will remain in the same parity situation. That is the logic of adjusting the stock price because of dividend or bonus. It happens in the same way for bonus. So have you understood it now, Akash? Okay. Great. So then let's come back. So we have discussed cash dividend, scrip dividend. The third topic is share buybacks. As an alternative to a cash dividend, a company can choose to return significant amount of cash to shareholder by means of a share buyback. Okay? So they can also, we have already discussed this. We can, the company can offer to buy back the shares of the shareholders at a price which is higher than the market price. Okay. What are the advantages of share buybacks? It avoids increasing expectations of higher dividends in future. Okay, so once you have bought back the shares, that they are no longer the shareholders, and it reduces the expectations of higher. I mean, the remaining shareholders, that the company will not be paying dividends now. It is choosing to reward us in the form of share buybacks. So if you want to tender your shares in that buyback, do it, or else just don't expect dividends from us now. So it avoids increasing expectations of higher dividends in the future. Then it provides disaffected shareholders with an exit route. In this sense, it is a defense against a takeover. So what happens is, it is providing the the shareholders who are not like interested in the company anymore, they get a very good exit. As I told you, the buyback price is normally kept higher than the market price, right? So it provides an exit route to these shareholders. Then next is, it is taxed as a capital gain. Let me once highlight these points so that you can save your time next time when you're reading it. Avoids increasing expectations. Next is exit route to the dissatisfied shareholders. Then next is taxed as capital gain, which may be advantageous. See, again, this is international finance, so it is not specific to any country's tax laws. So they have said that it will be taxed as a capital gain, and it can be advantageous if the tax on capital gain is lower than the tax on dividend income. Okay. So earlier, like in India, dividend used to be tax-free, so this point would not have been valid. But in some countries where the tax on capital gain is lower than the dividend income, this is definitely suitable for the shareholders. It is an advantage for him if a company is, providing an option to share buyback. If the shares are undervalued, the company may be able to buy shares at a low price, which will benefit the remaining shareholders. Fewer shares will improve EPS and TPS ratios. This is primarily the reason why TCS goes for share buyback. Every time there is news of a share buyback by TCS, you should always know that unless you are in need of money, you should not offer your shares for buyback. And I'll tell you why. See, the company's directors, they are willing to offer a price which is higher than the market price. What does it show? It shows that the directors foresee that the value of the share will go higher than even that price, right? Only that is the reason they will want to buy the shares. Now, otherwise, why will they want to? So what happens is, this way a company benefits. If the shares are undervalued, if the company will benefit if they are buying back the shares at a lower rate than the true potential value of the share. So in case of undervalued shares, the company's directors, they normally go for share buyback because they get benefit in this manner. So if the shares are undervalued, the company may be able to buy shares at a low price, which will benefit the remaining shareholders. Fewer shares will improve EPS and DPS ratios. Okay. So this is the advantage of, obviously this is very fairly logical that when you are buying back the shares, and I told you that the shares get cancelled, the number of shares will come down. When the number of shares will come down, the EPS and DPS ratios will improve. When EPS improves, your PE ratio, which determines the value of the share, that will improve. So overall, the share price goes up in the future. If the company's fundamentals are good, after share buyback, mostly the remaining shareholders, they benefit. Okay, and that has been the history for at least TCS. Okay, so what have we studied? Scrip dividend and share buyback. Next topic is special dividends. Any doubts so far? Shares are undervalued. How come? Okay. You know, right? Share prices are a function of market forces. When COVID struck, okay, share prices fell dramatically. Did that mean that the fundamentals of the company have changed so much that the company should be shut down? All the share price, I mean, if each and every company's share prices fell dramatically, okay, that does not mean that the company is not good. So in that case, in those scenario, it was being said that, you know, the shares, the good quality shares, they are undervalued, purchase them. And I'm sure if there is anyone who is holding shares from that point of time, they are in super profits, right? So if the shares are undervalued, it means what? Shares can be overvalued and undervalued. Now, discussing the price of Mama Earth a few hours back, what did we say? That the price seems inflated. It means that the shares are overvalued. So share prices, they are determined by the market forces, and sometimes they tend to be undervalued or overvalued, what they as compared to their true potential value. Did you understand, Ekta? So if the share prices, if the market forces have undervalued the share, in that case, the management always tries to buy them back so that, they are buying back the value of the share at a lower price and they will get benefited in the longer run. Okay. The other remaining shareholders, they will get benefited at least. Okay. So the next topic is special dividend. Another way of returning significant amount of cash to shareholders is via special dividend. Special dividend is nothing but interim dividend, right? You might have heard in the Indian context that there are two types of dividend: final dividend and interim dividend. So final dividend is the dividend you pay after the year end, right? When you have decided, found out what is your profit, what is your dividend capacity, then you pay that final dividend. Interim dividend is paid during the year, just to reward the shareholders. So that's special. It is a special dividend. It's not something that you are paying out of the profits which you have earned. It is a way to reward the shareholders. So another way of returning significant amounts of cash to shareholders is by way of a special dividend, a cash payment far in excess of the dividend payments that are normally made. Okay. This has a similar effect of returning significant amounts of cash to shareholders, but unlike a share buyback, it impacts all the shareholders. See, in share buyback, only the shareholders who are tendering their shares, they get the money back, right? But in case of special dividend, it is paid to all the shareholders, just like normal dividend. Okay. A special dividend is more attractive than a share buyback if the shares are overvalued and avoids shareholders potentially diluting their control by participating in a share buyback. Okay. So in a share buyback, what happens? The shareholders, they give their share, right? And that reduces their control. It dilutes their control. But when special dividends are paid, it does not dilute the control. it actually is an attractive option if the shares are overvalued, because the share prices, they will fall once the dividends are paid. And once that correction happens, then it is possible that the market forces will not, actually make it overvalued again. So the prices, they reflect that change, the fall because of dividend and also because of the other reasons, and then the true value of the share can happen. Okay, so a special dividend is like an interim dividend. Share buyback, you understand. Scrip dividend is like a bonus share, and cash dividend you already know. So this is interim. Cash dividend, which we normally call, is the final dividend, which is paid after the year's profits are arrived. Okay, so that is the last topic. Let me highlight here as well, and that is in excess of the dividend payments that are normally made. That is the meaning of special dividend. Is it fine, everyone? Can the company reissue the shares it has bought back? Not to, like, those shares which it is buying back, it will be cancelled. It will have to make a fresh issue. It's not like what you have bought back, you will issue back again. No, that can't be done. Okay, so this chapter is over. We'll move to the next chapter. Let me open it. Okay, so the first chapter was financial strategy formulation. This is for financial strategy evaluation. Okay, chapter number 2. Okay, so as I said, we are covering dividend decision in the first chapter. Now we are going to cover financing decision. Okay, so what is the primary objective of a profit making company? Now you should remember this. Tell me very quickly. What is the primary objective of a profit making company? Very good. It is wealth maximization. Shareholders wealth maximization. 1 second. Yeah. So the primary objective of a profit making company is normally assumed to be maximizing the shareholder wealth. Investments will increase shareholder wealth if they cover the cost of the capital. And now you know this, right? You invest in something only if the returns from that investment is higher than the cost, correct? So investments will increase the shareholder wealth, meaning what? The share prices will increase if the investments which you are making, they cover the cost of capital and leave a surplus for the shareholders. Okay. The lower the cost of capital, the greater the wealth that is created. Obviously, let's just discuss it with numbers. 1 second, I'll open one Excel file. So what I'm saying is your cost of capital is 12%. Okay. The return which you are making, return on investment or ROI, I'll simply write ROI. Please be aware of these acronyms, ROI. That is 15%. Okay. What is the gain that you are making on this investment? 15 minus 12, 3%. What it is saying is that if your cost of capital goes up, there is increase. I mean, it is better, obviously. So if now my cost of capital is 8%, I'll be making a gain of 7%. So this is definitely a good, I mean, plus point if your cost of capital is going down. So what it is saying is the lower the cost of capital, the greater wealth that is created. Obviously, the benefit will go up. So if the benefit is going up, it means what the wealth of the shareholders is getting created, right? So in order to be able to minimize the overall cost of finance, it is important initially to be able to estimate the costs of each type of finance. What are the two types of finance? What are the two types of finance? Debt and equity. So if you want to reduce your overall cost of capital, you need to focus on reducing the cost of each one of these types of finance. That is what is mentioned. In order to be able to minimize the overall cost of finance, it is important initially to be able to estimate first. First, you have to estimate that what is the cost of each type of finance. You have to find out the cost of the different forms of capital will reflect their risk. Debt is lower risk than equity because debt ranks before equity in the event of a company becoming insolvent. Let's read it. I'll explain each one of them through numbers and examples in Excel. And because interest has to be paid, therefore debt will be cheaper than equity, and the more security attached to it, the cheaper the debt it should be. These cost of capital calculations can be performed as a part of an evaluation of different proposed financing strategies or as a part of evaluation of investment decision. Okay, let's come to Excel and discuss this. So what it is saying is that the cost of capital comprises of cost of equity plus cost of debt. Okay, now please understand a few things. How it is denoted in the finance world. Cost of capital, it is called as KC. Okay, and KC is kept in the subscript. I mean, C is kept in the subscript. Okay, and cost of equity is known as, I mean, KE. Plus cost of debt. This is how it is denoted. Okay, that cost of capital is equals to cost of equity plus cost of debt. Okay, this is the very basic formula. We always have to use the weights of equity and debt, but we'll come to that later. But fair understanding should be that the cost of capital represents the cost of equity as well as cost of debt. How is cost of equity represented in finance? KE. And how is cost of debt represented in finance? KB. And cost of capital is represented as KC. Okay. Now, what it is saying is basically to reduce. Why do you need to reduce the cost of capital? So that your wealth improves further. Now, if you have to reduce the cost of capital, you have to focus on reducing the cost of equity and cost of debt. We need to understand that each of these costs reflect the risk inherent in each type of finance mode, in each type of finance, right? So as we discussed, there are two types, right? Debt, okay, I'll write equity first, and debt. Imagine yourself to be Once you imagine yourself to be a debt holder, and later you imagine yourself to be an equity holder. So when you are the debt holder of the company, you are given a fixed interest, right? And that is also mandatory, right? It is as per contract that you have to get the interest. Then prioritized during liquidation, can I say? That in the order in which the debts, I mean, the monies will be paid to the stakeholders, debt is at the top, creditors. Are these three qualities correct for debt holders? Any doubt you have here? Is this fine? Why is everyone so silent? These three qualities are true for debt. Then what about equity? Do equity holders, they get fixed dividend? No fixed dividend. Is it mandatory to pay dividend? No, optional. And are they prioritized during liquidation? No, they only get residual. That means leftovers up during liquidation, right? So tell me, who bears high risk, equity or debt? Equity has high risk, debt has low risk. Why? Because of these three reasons. And here also one more thing, there is security. Right? There is security which backs the debt. So definitely the level of risk here is significantly low as compared to equity. So equity always have a higher cost. So higher the risk, higher the return. Okay, I'll go in this way. Return expected. If you are taking higher risk, you will definitely expect higher return. Return expected will be high, return expected will be low. And we know that return expected by the investor is the cost for the company. So the cost of the company here will be high and here it will be low. Do you agree or not with this table? Is it fine? Any doubts? Very simple. I believe this you should already be knowing, nothing new. Okay. Everyone, please be attentive. Is this table fine with you all? Okay. Okay, so that is what is written here. See, read it now with that explanation in mind. You read this. The cost of the different forms of capital will reflect their risk. Debt is lower risk than equity because debt ranks before equity in the event of a company becoming insolvent and because interest has to be paid. Therefore, debt will be cheaper than equity, and the more security attached to the debt, the cheaper it should be. The more the security, the better the security give, the cheaper rates you will get for debt finance. Now, in this chapter, the focus is on learning how to estimate the cost of each types of finance. That means how to calculate cost of equity and how to calculate cost of debt. That is the primary focus of this chapter. Okay. So the first thing which we will be learning is the calculation of cost of equity using the capital asset pricing method. I can't tell you how important this is. Like sometimes I keep on telling them this is very important, very important. This is one of those topics. So capital asset pricing method, calculating the cost of equity using CAPM, it's super important. So like cost of debt we'll also be learning, but cost of equity is a little complicated to calculate. Okay. So for that, a model was developed by a lot of, statisticians and financial professionals years back. So cost of cost of equity using capital asset pricing method is the most effective and accurate way of calculating the cost of equity. So cost of equity, see, sometimes you will see it referred to as RE. Sometimes you will see it referred to as KE. Can you tell me why RE and KE are being used interchangeably? Can someone explain? Why is R and K being used interchangeably? Very simple, please tell me. Exactly. Good, Ekta. So cost to the company is same as the return to the shareholders, right? Return to the shareholders or return to the debt providers. So you will see that RE being used interchangeably with cost KE because both of them denote the same thing. The return expected by the shareholders, that is what the cost to the company is, right? That is why cost of equity denoted by RE is the return expected by the shareholders. It is calculated using CAPM, which is discussed in stages below. See, there is a very simple model. We could have, just simply stated the model that this is the final conclusion we're going to get at the end of it. 1 second. Okay, this is something which you need to know. But with the stages which I'm going to cover in the next few slides, you will learn why the formula of CAPM is the way it is. Okay. No one is going to ask you the logic behind it, but as finance professionals, I believe that you should know the logic behind the most important formula of calculating the cost of equity. So that is why I've covered it in length here, and I'll be covering a lot of theory topics also here. So please be attentive. It's very interesting and very important for you. Okay, so we are finding out the return expected by the shareholders, right? Now, return expected by shareholders, to start it off with, what is the bare minimum investors expect when they're putting their money in the shares of a company? So imagine yourself, okay? You have 1 lakh rupees in your bank account, which you want to invest in a company. So you're getting an interest rate of, let's say, 4% on fixed deposits. 4% is what you're getting in the fixed deposit. Now, when you put your money in the shares, what is the bare minimum you will want from the company? Like, if the company is giving me returns which is lower than this percentage, I will not put my money in this company. What will be that threshold? 4%? Because FD is like, typically it doesn't have any risk, right? It is risk free. So when an investor puts money in the shares of a company, he expects a minimum of risk free rate. Okay, so this yield on FD which we are referring now, it is actually the yield on government securities, because FD rates, they also differ from bank to bank, but the government bonds, they remain the same. So and of course government bonds are definitely risk free. So this is the risk free return, the yield which we get on government securities. It is denoted as RF. Investors expect a higher return when investing in a company's shares. Excess return demanded by investors for bearing this risk is called risk premium. So what will be the return required by the shareholders? RE is equals to bare minimum RF, that is the risk-free rate of return, what I would have got by investing, by putting my money in a government bond. Okay. So Avinash, we'll come to that. So RF will normally be taking annual, just for your reference. Yes, the government bonds are of different tenors. We'll be taking the annual rates. Okay, but you don't have to worry about it from exam perspective. It will always be given to you directly. So RF is the bare minimum return which an investor would want when he's putting his money in the share market, right? In the shares of a company. RF plus risk premium. Because when you are putting your money in the shares of a company, you are taking risk. So for taking the risk, you will definitely ask for premium. So that is risk premium. The premium which you're asking from the company for bearing risk by investing in your company's shares. Otherwise, I would have invested in FD. There was no risk there. I could have earned the risk-free rate. If I'm putting my money in your company's shares, you have to compensate me for the risk that I'm bearing. I'm putting 1 lakh rupees. It is possible that those 1 lakh rupees become zero. Okay. So if anyone of you who has been investing in the share market, I'm not sure, if you ever put your money in a penny stock, you will, I don't know if, I wish no one would have gone through it, but it happens. Penny stocks, they become zero. If the company fails, a lot of those stocks, they turn just zero. What it means, the shareholder who put his hard-earned money in those shares, it can become zero. That is why, it is said that, when you are putting your money in small cap, so there are 3 caps in the Indian stock market: large cap, mid cap, and small cap. Large cap are those shares where, all the blue chip companies like Infosys, IBC, Reliance, HDFC, companies of that sort are placed. Okay, so that is the large cap, the blue chip companies. Then comes the mid cap. So there is a differentiator, capital, capital in circulation in the market. All of those differentiators are there to decide whether it is a large cap, it is a mid cap, or a small cap. But small cap, I hope you understand, it will be, mid cap will be better. Having lower, yes, they will have a lower capital in comparison to the large cap. Then comes the low cap or the small cap. So small cap, very risky companies. You can get very high returns, but at the same time, there are chances of very high losses as well. Your money can go completely if you're putting your money in a small cap. So higher the risk, higher the return. So if you're putting your money in the share market, you are definitely, it is possible that the money can become zero. Okay. So when you're putting money, you are in a share, you are going to ask for that premium, risk premium. So that is what RE, that means the return expected by the shareholders, is equals to risk-free return plus the risk premium. Is this part clear? Very simple equation. Imagine yourself that when you are putting money in the shares of a company, what is the return you expect? You expect bare minimum risk-free return plus a premium, which you will be corresponding to the risk that you are taking by putting money in that particular company. Okay, it's a very simple equation till now. Then, okay, let me know now, anywhere if you want me to repeat anything, just let me know in the chat box. Next stage is the types of risk. So we understand that there is a risk premium. To understand it better, we need to know the different types of risk which exist in the market. There are 2 types of risk. Number 1 is unsystematic risk, and second one is systematic risk. What do you mean by, I'll come to these also. Let's just call it unsystematic risk for the time being. Unsystematic risk is the risk which an investor suffers only if he behaves irrationally. That is, he invests all his wealth in a single stock. Have you heard the saying, do not put all your eggs in one basket? Have you heard that? Yes. What does it mean? Why is it said that do not put all your eggs in one basket? Very good. Akash, Avinash, and Ekta, you're giving me the right answers, because if that basket breaks, you will not have anything left behind. So what you should be doing, that you diversify. Like in the context of basket and the eggs, it is like placing eggs in different baskets. So it's not like now all the baskets will break together. So the probability of that happening is very low as compared to that one basket breaking. So same way, stock investment also works. And same way in like life, everything works. So you have to keep yourself diversified. So when you're putting your money in a stock, it's not like all of the wealth that you have generated, all of your family wealth, everything, you will just put in one stock. It's not like that. That is a very irrational behavior, and no one would be actually, and no sane person would be doing it. So when you are putting money in the stock market, you tend to diversify. Let us say you will put some money in the oil and petroleum sector, some you will put in, agriculture sector, irrigation, in technology. So you diversify your investments, right? And that is the rational behavior. So unsystematic risk arises when an investor behaves irrationally by investing all of that money in just one stock. Okay, so that is the reason it is known as unsystematic risk, because that is the attitude of an irrational person. Specific risk because it is specific only to those shareholders, I mean to those investors who are behaving irrationally. Again, specific risk, specific to that investor only. It is not reflecting the risk which is borne by the market as a whole. So unsystematic risk, specific risk. Why? Because it is specific to that investor who is behaving irrationally. And the third is diversifiable risk. It's the name of the same topic. So why is it called diversifiable risk? Diversifiable risk is because this risk could be avoided by diversifying the portfolio. That's what's written here also. Investors can eliminate this risk by diversifying their portfolio. He is behaving irrationally, that is specific to him. Okay, so that is unsystematic risk, oblique specific risk, oblique diversifiable risk. Are we clear so far? Okay, the second type of risk is systematic risk, oblique market risk, oblique non-diversifiable risk. It refers to the risk that will remain even in a well-diversified portfolio. So let us say you are a rational person, you diversified your portfolio and you invested your wealth in a lot of stocks, in a lot of companies. Does that mean you will never suffer a loss? Does that guarantee, does diversification guarantee that you will not bear a loss? It does not, right? So what does it mean? That risk which remains even after diversification, that is your non-diversifiable risk or market risk. That risk reflects, that risk is there because you are in the market, you're investing your money in the market, so there will be some element of risk. So it refers to the risk that will remain even in a well-diversified portfolio because it is determined by general market factors. Example, recession. Example, COVID. All the stocks fell. Like even if you were having a well-diversified portfolio, you would have been in tremendous losses, right? So this risk is not in your control. This will remain even if you are diversifying your portfolio. Okay, so that is why it is known as systematic risk. Risk which is there even in the portfolio of a rational person who has diversified his portfolio. Okay, so systematic risk, oblique market risk, oblique non-diversifiable risk. Meaning, I hope you have understood why each one of the names are relevant for them. It affects all stocks in the same direction. Like when there is news of recession in the US markets, all the stocks are going down, right? It's not like only Apple stock is going down or only Microsoft stock is going down. It's not like that. All the shares are going down because of the recession. These risks cannot be avoided. if you're putting your money in the market. Okay. So CAPM assumes the capital asset. So coming back to the topic, what have we studied? That the return expected by the shareholders would be the risk-free return plus the risk premium. Now the CAPM, that means the capital asset pricing model, assumes that investors hold a diversified portfolio. That the investors mostly they are rational. Thus, only systematic risk is relevant. Okay, this we are not even going to consider. We will not see that that investors they are irrational. We will assume that all the investors they have a diversified portfolio. So now, can I change the equation like return expected by the shareholders is equals to a risk-free rate plus the systematic risk premium, to be specific. Okay, here we had said return expected by the shareholders is risk-free rate plus risk premium. Now we are smoothing it more and calling it that risk-free rate plus the systematic risk premium. Is that fine? Very, very important slide. Types of risk you need to understand: unsystematic risk and systematic risk. Even theory topics get covered here. So you should be knowing. Can you explain stage 2 again? Sure, Mona. So listen to this. We concluded that a person, an investor, he will be asking for a risk-free rate plus the risk premium. Now we are breaking down the definition of this risk premium. We understand that in the markets, there are two types of risks: unsystematic risk and systematic risk. Unsystematic risk happens only in those situations where an investor puts all of his money and wealth in just one stock. Okay, so definitely his risk will increase many folds. Okay, and systematic risk is the risk which remains in the portfolio even after diversification. So if you have invested your money in a lot of different industries, still there is a probability that your investment can go down. Like, see, if you put your money in an FD, do you think that value of the FD will come down? It never happens, right? Whereas when you're putting money in the stock market, you should be aware that your value can become zero also. So that is systematic risk, the risk which remains in the portfolio even after diversification. This is the risk which cannot be diversified. It is there because of the market forces. What are the examples of market forces? Like recession, like COVID, the pandemic, when it happened, all the stocks moved down. Does that mean that the rational investors were not rational who invested in those stocks? No. These risks could not be avoided even with diversification. So that is why we call that there are two types of risks. Okay, systematic and unsystematic. CAPM, that model which was developed by technicians by mathematicians, statisticians years back, it assumes that investors, they diversify their portfolio normally, that investors are rational in their approach. So unsystematic risk is not relevant because investors, they have diversified their portfolio. So what is the relevant risk for us? The relevant risk is systematic risk. So can I change this formula to write it as RE is equals to RF plus systematic risk premium? That's what I've written here. Let me know if you've got it. Okay, Mona says got it. Great. Then the third stage, we are going to talk about beta of the stock. 1 second. Okay. So beta of the stock. For the purpose of measuring systematic risk, CAPM considers a well-published market index, such as Nifty, to represent the economy. Okay. So we have to measure systematic risk now. Now, systematic risk assumes that, there is a well-published market. Obviously, it's nothing to assume, it is always there. Every country has its own index. So CAPM considers a well-published market index. Like in our country, we have Nifty, there is NASDAQ in the US. So each country has its own index. It measures that for a stock, which is a part of that big index, what is the sensitivity of that stock with respect to the return on the market index? Meaning to say, now if you look at Nifty movements, okay, please start, at least for some time you should spend on the markets. You will relate to my classes much more and you will see things practically happening. See, Nifty moves by a certain percentage. It doesn't mean that all the stocks in the Nifty, they will move by the same percentage up or down. It might so happen that Nifty moves by 0.5%, but a particular stock might move by 5% on the same day, plus 5. And it is also possible that Nifty has gone up by 0.5%, but the stock has gone down by 10%. Are you aware that this can happen? Or do you think that all the stocks, they move like in a herd together? It's normal, right? So what CAPM says that beta of a stock is the sensitivity of a stock, general sensitivity, not event specific, like once upon a time, like it happened for Adani. The stock market might have moved up, but Adani was going down daily. Like for a few sessions, it just went down. So normally, how does a stock, how does it change? How does it react to a certain percentage change in the Nifty? So beta of a stock refers to the sensitivity of a stock's return vis-a-vis market return. Okay. So what does it show? That, if the market index is moving by 1%, so if the Nifty is going up by 1%, what happens to that particular stock for whom we are calculating the return expected by the shareholders? How does it move? So if, let's say I'm talking about Adani only, or let's take an example of a normal company, ITC. So ITC, if the Nifty moves by 1%, let's say the stock moves by 1.2%. That has been the trend in general. So what will we say? That the beta of the stock is 1.2. So beta of the stock refers to the sensitivity of a stock's return vis-a-vis the market return. Higher the beta, higher the risk in the stock. Can you tell me how? So let's say ITC has a beta of 1.2. Adani has a beta of 10. What does it mean? That if the market moves by 1, Adani will move by 10. It shows that if the markets are going up, yes, good. One market goes up by 1, Adani will go up by 10. But if the market goes down by 1, Adani will come down by 10. So do you agree that beta of the stock reflects the quantity of the risk? Higher the beta, higher the risk. Please take a moment and let me know if you agree or not. See, what we are studying is we have to find out what is the expected return by the shareholders. So we have understood that yes, the shareholders want a minimum of risk-free rate plus the systematic risk premium. Okay. Now, systematic risk premium, we have to measure the systematic risk premium now. So for that, now we are finding out how to measure it. So first we have the quantity of risk. Okay. One second. So quantity of the risk will be beta of the stock, because higher the beta, higher the risk. As I told you with numbers, for example, in case of a stock market downturn, which happened during COVID, luxury items shares, hotel share, they would have dropped more than the drop in other shares, right? Like hospitals, like for Reliance. Yeah, PVR is a very good example. So hospital, like PVR, then hotel industry, the travel companies, all of them had a major setback. So there are some companies who have higher beta because, you know, they do not like, they are very seasonal in nature. So higher the beta, higher the risk in the stock. That is, beta represents quantity of the risk. Agreed? So when a company has a higher beta, it has to be very careful, because if there is a stock market downturn, if the Nifty index is going down by 10%, then the impact on the shares will be like tremendous. It can be very heavy on the shareholders. Okay. Then, so we have understood that this is the quantity of the risk, beta of the stock. Then let's find out the price of the risk. Okay. See, what do we say? I believe you know that quantity multiplied with rate gives you value of anything. So if you are going to buy 5 Cadbury, right, and you're buying it at the rate of 10 rupees, so can I say the value of Cadbury is 5 into 10, 50? Okay. So that is the value of Cadbury. So in the same way, I have to find out the value of the systematic risk premium. I have found out the quantity of the systematic risk. We just have to find out the rate of risk, right? Or the price of risk. So how do I find it out? We have to understand that beta of government security is 0. Why will it be 0? Why will beta of government bonds be 0? Are government bonds affected by the movement in the Nifty? Because they are more safe. They do not. See, beta measures the movement of anything with respect to the Nifty. So obviously government bonds returns, they will not change as per the movement in Nifty, right? So beta of government security is considered as 0. And beta of market portfolio means Nifty, right? Market portfolio is the portfolio of all the stocks in the market. So that is considered as 1. So it means that by investing in market portfolio instead of government securities, an investor is able to earn excess return by RM minus RF. Very, very carefully, please understand. Okay. When an investor is putting his money in the market portfolio, that means he is putting his money in the Nifty. So he will earn RM minus RF return by suffering 1 unit of beta, that is 1 unit of risk. Read this line. By investing in market portfolio instead of government securities, an investor is able to earn excess return, that means return from the markets minus the return from risk-free investments, by suffering 1 unit of beta. Very important statement. Read it 2-3 times and confirm if you are able to. I've written it in very, very simple words. Read it and let me know if you are understanding it. See, Manan, I understand your frustration, but it's very basic if you look at it. See, when you're putting money in Nifty, you're going to get some higher returns, right? as compared to the money you are in, I mean, return which you will get by investing in government securities. So it is basically talking about that by investing in the market, that means Nifty, and bearing that risk of 1 unit of beta, I am going to earn incremental returns of RM, that means the return from the market, minus the return from the risk-free securities. Okay, so that is what is written here, that RM minus RF is the price of risk. By bearing one quantity of risk, that means 1 unit of B, I am able to earn RM minus RF. That is the price of risk. Therefore, systematic risk premium, like I said, quantity multiplied with rate, it is equals to RM minus RF multiplied with beta. Now that beta will be of the stock, whichever stock for whom you are calculating the return for the shareholders, now beta of the stock you will be using. So this is the equation. CAPM is given by return required by the shareholders is equals to risk-free return. Bare minimum he wants that return, plus the quantity of the risk which the shareholder is taking. Higher the risk, higher the return the shareholders will want. So beta represents that risk. And how much extra do you want? Return from the markets. Please understand, this is RM, not for the stock. Return from the market only. Because this beta is dependent on the movement of the market, right? What is the definition of beta? Movement in the stock because of movement in the market. So in its denominator is setting the market. So that is why we will be comparing it with the market return. RM minus RF multiplied with beta. This is the equation which is known as the CAPM equation. It will also be given in the exam. But I really want you to know each one of these elements. What is risk-free return? What is systematic risk? What is unsystematic risk? What is beta of a stock? Very, very important. Beta is very much relevant in later parts of the chapters also, like subject also overall. So beta is the risk of the stock and in comparison to the return of the market. Okay. So Manan is saying, so systematic risk also varies for blue chip and non-blue chip companies. Shares as beta of non-blue chip companies would be more. Absolutely yes. Systematic risk will change. See, return required by the shareholders, obviously it will be different when you're investing money in the blue chip company versus when you're investing in a non-blue chip company. Definitely this will change because RF will remain same for both the types of companies. Only it is this part that will undergo a change, and within which it is the beta of that particular stock which decides what the expected return of the shareholders would be, and beta reflects the quantity of the risk by investing in that particular stock. Okay, so all of you, I would really appreciate if you just absorb this and give me a confirmation that yeah, we are clear. More or less you need to know this only, but these concepts will be helpful for you to logically understand what you are doing. So we have to which to take. I told you annual RF yield on the annual yield on government securities, Avinash. Annualized yield you will be taking. Okay, Munna, Akash, Avinash, they're clear. Rest also please confirm. Very, very important concept. Ekta, Manan, Sai. Sai, should I wait for you? Okay, so we'll move ahead then. I have a question for you. Do it quickly, huh? So as I told you, make a habit of reading the requirement first. What are you required to do? Estimate Mantra company's cost of equity. Mantra company has an equity beta of 1.5. Assume there is a market premium for risk of 4% and the risk-free rate is 2%. Read the words very properly and then give me the answer. Akash has given me the answer. Others also, please try. What happened, everyone? Why so much time? It's a very simple question. I thought you'll be just busting up with the answers. Ekta is saying 5. Okay. Ekta, read the question properly. So Munna, Manan, Akash, and Ekta have shared. What about Avinash and Sai? Sai is silent for a very long time. What happened? Avinash, you please share. So let me show you the model answer. Good effort, guys. Have a look at this. Okay, so beta was given to us as 1.5 and very, very important. RM minus RF was given as 4%. So if you read the question again, I'll just show it to you. Market premium for risk. Did it write market return, Ekta? Did it write market return or market premium? It has given you market premium for risk directly. Okay. So it means it has given you RM minus RF as 4%. Got it? So RF, very simply, 2%. So we get, now we have to simply put it in the formula for formula. RF is 2% plus RM minus RF is 4% multiplied with 1.5. This, the three of you did it fine. Ekta, I think, mistook this part. It's okay. That's why I said always make a habit of reading the questions properly. They just twist around, spin around these simple terms, and the entire answer just gets wrong. Okay, let's move to the next slide. Let's see what are the limitations of CAPM. It's a theory topic, but as I have shown you also, exams are theory plus practical. So you can expect questions like this, evaluate the CAPM model. So if you're asked to evaluate the CAPM model, you have to write about the model, right? How it is calculating the return expected by the shareholders, and that there are some limitations to this model. Now, what are the limitations? Let's discuss that. Estimating market return. Okay, first one. This is estimated by considering movements in the stock market as a whole over time. Okay, this will overstate the returns achieved because it will not pick up the firms that have failed and have dropped out of the stock market. When you are using RM, okay, market return from the market, you are using RM in your formula, right? So you are considering movements of the Nifty index. Please understand that Nifty index is also like there are add-ons and then there are eliminations from the Nifty. Do you know about that? That the stocks, they are added, then they're removed. And it is a gradual process which keeps on happening. The companies which are, not functioning well or which are not able to live up to the standards of the stock market, they are removed from the Nifty. Okay, they are delisted. So when you are capturing the movements in that market return, right, you will be picking up only those firms who have been able to live with the time. Those companies which have failed and have been removed from the index, you will not be capturing their impact when you're calculating RM. Please let me know if you have understood what I'm saying. When you are calculating RM, and what is RM? RM is the return from Nifty. That return from Nifty, when you are capturing only of those stocks which have been able to, survive the tides of time. There have been a lot of companies which were once a part of Nifty, but they have now been delisted. So will you be having the impact of those stocks in Nifty now? No. Will it be capturing zero return for those stocks? No. Or negative returns? No. It is only capturing the return of those stocks who have survived the tides of time. So that is a limitation of CAPM model. That when you are estimating the market return, you are capturing the return only by those stocks who have survived. Those stocks that have failed, their impact just goes away when you're calculating RM. Okay. Next limitation of CAPM is the estimation of beta. Okay. Beta values are historical. Historical in the sense, as I told you, you will be capturing the movement in a particular stock over time as compared to the market. Over time means what? It is historical. So beta values are historical and will not give an accurate measure of risk if the firm has recently changed its gearing or its strategy, right? So if you are changing your business, see, basically one very important thing, let's cover that also today. Okay, very important topic. Business risk and financial risk. A company is exposed to the two types of risk. First one is business risk, second one is financial risk. Okay. Beta will be given to you, but in some questions, it will come later. Don't worry. There are both possibilities are there. Sometimes you'll have to calculate the value of beta. Sometimes it will be given to you. So there are both the possibilities. But for the time being, understand it will be given to you. Okay. Okay. So business risk and financial risk. Okay. Just know this much, that a company is exposed to two types of risk. What is business risk? Business risk is the risk which a company faces for being in a particular line of business. Okay. That is, or example you can take, ITC is exposed to risk in the tobacco industry. Right? That is the business risk it has. Because it is doing a certain business, it will be exposed to business risk. Correct? Next is financial risk. Can someone help me? What would be the meaning of financial risk? Just make a guess. You do it capital structure. Example, if a company is highly geared or leveraged, please start remembering these terms, geared, leveraged. If a company is highly geared or leveraged, it will have high financial risk. Understood? So a company is exposed to the two types of risk, business risk and financial risk. Business risk is the risk which a company faces for being in a particular line of business, and financial risk is the risk which a company faces because of its capital structure. So this much you should be aware of. Now, what is it saying? Come back here. Beta values are historical and will not give an accurate measure of risk if the firm has recently changed its gearing or its strategy. Gearing means what? It will impact the financial risk, okay, or its strategy. Now, if ITC, which is a tobacco company, is now also getting into the liquor industry, so its strategy is changing. So its business risk will also change. So very, very important. Please understand that beta of a stock, I'll just write it down here as well. Please remember this. Beta of a stock reflects both financial risk and business risk. Okay, very important. Remember this. Okay, that is what is given. So you are estimating the beta on the basis of what has been the movements in the stock in the past, in the history. But what if you have changed your gearing recently, or what if you have changed your business strategy recently? I believe the beta should change, right? But the CAPM model does not do it. It just captures the beta which has been in the history. Then the next limitation of the CAPM model are the risk factors. It has been argued the CAPM ignores the impact of the size of the company, the extra risk of failure for smaller companies. Of course, you should be knowing that, smaller companies, like we were discussing only, small cap companies, they have a high risk of failures. So that way, the size of the company also matters when you are, calculating the expected return by the shareholders. See, understand this. There could be two companies in the same industry. Okay, so for example, let's take ITC hotels. Okay, they're in the hotel industry. It is a large cap company. Similarly, there is like a Madhu Mohan hotel in your locality, for example. Both of them are in the hotel industry, but just compare the size of ITC hotels with that Madhu Mohan hotel. Is it right to put them in the same basket? It is not, right? So just because you are in a particular industry is not the only factor which determines your risk. It is also your size. Okay, the size of the company, the risk, the extra risk of failure for small companies, that should be factored, but CAPM is not doing it. Okay, the ratio of book value of equity to market value of equity, that is, shares with book values that are close to the market values are more likely to fail. Okay, so what happens is when you are calculating the beta of the stock, you are comparing it to the market returns, right? But it is possible that the balance sheet is not reflecting that. So all of those, the gaps in the numbers, that does not get captured by CAPM. It's a very basic model, like, that return, risk-free return plus RM minus RF into beta. Okay, just remember this equation, RF plus RM minus RF into beta. That's a very basic model, but there are a lot of other factors also which impact the expected return by the shareholder, but they do not get captured in the formula. Okay, so like the book value of the shares, the size of the company, it's not getting captured anywhere. And there are problems in the estimation of market return and the beta factor. Okay, these are the limitations of the CAPM model. Any doubts? It will be important for framing theory answers. Huh? Akash says, can you repeat the book value part? Okay, so CAPM, it is only considering the market returns, right? RM minus RF into beta of the stock, and beta of the stock is also getting calculated on the basis of its market movements. Okay, do you know that the markets, like we have also discussed just few hours back only, that the market prices can be manipulated by the market forces? So what if the book values and the market values are not in tandem? There is a scope of manipulation, that there has been some manipulation in the market prices of the stock. So it does not consider book value anywhere in its calculations. Okay, it is just capturing the market value, which could be also a factor for a company failing if it does not have any assets on its balance sheet. There was a time, like these shell companies were also trading. Now SEBI has become very strict, but of course there is always some scope left, right, for improvement. So those bogus companies also used to trade on the market. Now it doesn't have anything on its balance sheet, and they are trading just because they are in the stock market. Is it right to calculate the expected return of the shareholders on the basis of that? It's not, right? So that is what it is saying, that CAPM model does not capture the book value of the shares, or like the book value of the shares, or you can say the assets and liabilities of the company which are sitting in its balance sheet. So Mona says, so you mean the share prices can be undervalued? Those are not factored here, right? I'm not saying undervalued. There are a lot of other factors which also impact the return required by the shareholders, which does not get captured in the CAPM model. That is what I'm saying. There are other risk factors also which CAPM model ignores. In simple that. Is it fine? Okay. Munna, what about you? Understood? Okay. Ekta had said yes. Others, are you all right? Understood? Any doubt? Avinash, Manan, Sai is silent. So if all is fine, then we'll wrap up the class for this week. So I'll share across the notes for the introduction chapter and chapter number 1, both the like PDF you will get and the Excel. So I'll ask the team to upload it in the drive. Ignore that part, Avinash. So what I'm trying to say is that, you know, there are other risk factors which are ignored by the CAPM model. And that is the ratio which happens between, ignore that bracket part, ratio of the book value of equity to the market value of equity. If there is disparity between the two, it denotes risk which is not factored by the CAPM model. Yes, Ekta, there will not be any homework for today's class. Like I said, they will be covering a few chapters and then I'll start giving you homework. Okay. Recordings, I'll have to check with the team. I'll ask them in lecture. They'll put it in the group anyways. Okay. Thank you so much, everyone, for attending the class. Take care. We'll see you next week. Bye-bye.